Very good evening to everyone who gathered here. Let us start today's session. First of all, we are directly going to the first session as our speaker has to go to Coimbatore tomorrow, so he has to catch a train. So, first of all, I directly enter to welcome our speaker, CA Kuntal Shah. He is from Ahmedabad. Uh, he's a very busy faculty nowadays. I'm thankful to Kuntal sir, for accepting our invitation and making this day for us. I welcome you to the spread. Thank you, sir. With these words, I welcome you all who have gathered here, and I request. I request our Sikata chairperson, CA Julie, to officially introduce the faculty. Thank you.
Respected faculty of the day, CA Kuntal Shah, our chairman CA Samuel, and other fellow members. Today we have CA Kuntal Shah, a fellow member of Institute of Chartered Accountant of India, to take the session, Audit under CBS Environment. He is partner at Pradeep R. Shah and Co. and he specialized in the field of audit, income tax, GST, FEMA, and company law. He has secured A+ grade in Diploma in Computer Programming of CDAC. He has been a part of panel of authors for guidance note on audit of banks 2019 and 2017 edition published by Auditing and Assurance Standard Board ICAI. He has also been a co-author of Manual on Concurrent Audit of Banks published by Internal Audit Standard Boards. Also a co-author of Early Warning Signals of Fraud through Credit Weakness, Review of Demonetization Activity by Chartered Accountants in Banks, Audit of Foreign Exchange Transactions in Statutory Bank Branch Audit, published by EIRC and WIRC. He has addressed various professional gatherings like ICAI's Certificate Course on Concurrent Audit of Banks, Advanced ITT course, CPE seminars, intensive course on service tax under negative list, etc. The topics deliberated by him includes role of concurrent auditor post demonetization, consolidated financial statement, preparation and presentation under Companies Act 2013, nitty-gritty of depreciation provisions under Companies Act 2013, preparation and e-filing of tax audit report, Excel workshops for members, and a bit about bitcoins, and the list goes on. With this, I introduce our faculty for the day to take the session under the topic Audit under CBS Environment. Thank you.
I might require some other PPT if not okay. I don't know which.
Okay.
Good morning to everyone present here. It's a pleasure to be sharing my views at Trivandrum branch. Extremely sorry, but I have to rush to catch a train, and that's why I had requested to postpone the inaugural session or something, so that at least we can have a detailed deliberation. Otherwise, always it becomes like that way that I need to rush for, and I'm not in the position to share the views or the members' queries remain unresolved. What we can do is we can I would be most happiest person if you have a lot of queries, then I'll resolve those queries as well. I'll first start with my presentation. I'll show you a few of the important points about audit under CBS environment. The presentation is about 6 to 7 hours, but I'll be taking only part of it, but I'll be sharing the entire thing with you as well. I'll send it across to branch, and branch in turn will be sharing with all the participants. I have written an exhaustive paper on CBA audit under CBS environment published recently by SIRC. So I'll share the same as well with the branch. Along with that, I'll share one of my presentation which I deliver in concurrent audit course, which is about 4.5 hours. So it is more detailed one than this one and contains certain other aspects. So composite material I will be sharing with the branch, and in turn that you can get that as well. Quickly starting through this part. Since I'm an auditor like you, I'll start with my disclaimers. These are my personal and not be considered the views of branch or of my firm. You should not be considered as professional advice. Images, screenshot, menu code, software name, etc. are the property of respective software developer or trademark owners, and information in this presentation is merely for guidance and not for commercial purpose. Uh, Starting with important updates, I think Dhananjay will be taking this in detail, but I would like to touch upon certain technical and the system aspect of this amendments. First three circulars are recently issued ones. A very important one to read those before going for the audit, because that is a paradigm shift that we can say now on into IRAC guidelines. Earlier IRAC guideline was the 1st of July 2015. Now the revised IRAC master circular is there of 1st of October 2021. It was not only that IRA got changed, the same 1st of October circular also got changed to a clarification circular or a notification dated 12th of November, and then there was further clarificatory notification was issued on 15th of February. So these three circulars are very important. There are few fundamental changes made into this IRA guideline by Reserve Bank of India. The changes are more towards the system, where you need the bank is required to make changes into the system so that the identification of accounts or the asset classification is optimized, and the same is carried out completely by system and without manual intervention. Right. So that is where we need to check that whether the compliance of the circulars are there in the bank or not. However, few of the part of the circulars are that is the 12th of November and 15th of February circular as a different implementation date. Latest being 31st of March 2022. So it may so happen that during this year you might get answer that sir we have just implemented on 31st of March 2022 and may not be in a position to get the full effect of this. However, if you are doing concurrent audit, then it will be applicable from first month, that is April only. If you are doing statutory audit next year, then it will be applicable for entire year. It is now, see, you can now see the paradigm shift of RBI guidelines with respect to automation of entire system. Many of the members do say that it is a controversial one, but many of the members do say that now probably bank audits would not be there, at least at the branch level in coming future. I am also of that opinion, but I have bit different reservation about this. See, basically the changes that are being brought in. What is important to have it is to have a concurrent audit in a more strengthened manner, rather than working for 4 days as a statutory audit and with a lucrative remuneration. Currently, what is happening is we are getting some respectable amount in statutory audit, but we are getting a mirage amount in concurrent audit, whereas the responsibility is almost equal. Right, but if we get some, see, in concurrent audit we get time as well, we get to use the system as well. Right. So probably, and even RBI in one of the paper, I think in 2008 also discussed this part, but nothing moved around into that afterwards. Probably it's my sense of expectation, or I foresee that Probably we'll have more of a concurrent audit now and less of a statutory audit, but that's all my personal opinion. As far as fourth circular is concerned, it is very important one, though it was not issued in this year, it was issued a year before. But it's very important circular, the reason being that that circular talks about automation of income recognition, asset classification and provisioning, wherein there have been specific points mentioned that what the banks should do, and this same circular is referred to in Master Circular of 1st of October 2021 as well. Why I am harping upon this part? Because under revised LFAR applicable from last year onwards, there are various questions that you need to answer, and wherein you need to take help of these circulars to ascertain whether the branch or the bank has followed the prescribed guidelines. Because what will happen is you cannot simply mention now yes, no into LFAR. Please don't do that. Otherwise, you will be making your own coffin. I am literally saying this. It may look very uh, curt as well. But the point is this, that in LFAR you need to mention in detail what you had asked for, which kind of reports that you have got, or what information you did not get. Right? What audit process you carried out, and then what is your observation. That shows that you have actually worked, and you have worked in a comprehensive manner. Because what happens is certain questions are loaded questions into this one, wherein you simply need to answer yes, or if you simply answer in yes or no, you will have a problem with in type of, let's say, I'll just take an example of one of this question. Is the DP properly computed? That is the drawing power properly computed? If you mention yes, meaning there were all the accounts that you have checked, everything was perfect. See, don't mention it that way in a blatant this one, that is black and white, that yes, this is the case. What you need to do is you need to mention in detail that we have asked for so and so information. First information, that is the circular that is prescribing that how the DP should be computed. Right? How you have selected the samples? What are the documents that you have seen? How the system is updated for that, and whether the system is also properly updated, because probably in certain cases we need to test it into our Excel as well, whether the DP is properly computed. Because many of the time we get a printed document signed by the borrower where the DP is perfectly mentioned, but when you compute it through calculator or system, you find something else. See, you need to see from end to end. You can't say that your DP is properly computed just by looking into it. Right. So carry out the entire process, mention everything. Now, few of the members do tell me that, sir, there are problems into this one, because what happens is that the banks have automized this, is asking us to fill up LFAR online in their intranet portal, whereby if you mention, if you select anything on a negative side, then only it opens up this remarks column, that is field, right? So I would say that you mention negative, even though you don't have any negative, but you have some space to write. Write it, right? Don't give a crystal clear answer where you have not carried out that activity. Yes, if you have carried out that activity and you are 100% sure, you can give an absolute assurance there. But if you are not in a position to give an absolute assurance, don't give absolute assurance. Otherwise, it will create, or it will boomerang on you only. So please read this 14th of September 2020 circular, that important points are there. What we need to do is, if we find that any of the clause mentioned into that circular is not adhered to or not implemented, you simply need to write at respective places in LFAR that this is not done, this is not carried out, this is not carried out. And if you happen to find out some manually some other accounts as well where this was an issue, mention that we have also observed these accounts which should have been marked as NPA, but the system did not mark the account as NPA. What may be the reason, right? So if you are aware with the reason, or if you could zero it on the reason, you can mention the reason. If you are not in a position to do it, just mention that the system is not configured properly, right? But please mention. Don't keep LFAR as a very short and crisp kind of Q&A session, right? So these are the points with respect to system. Let's understand few of the points with respect to the updates. I will only touch upon the system part of the updates. I will not go into detail about other aspect. Identification of NPA account, non-payment of interest. Para 2.1.3 of IRAC Circular 1st of October 2021 talks about, in case of interest payment, bank should classify an account as NPA only if the interest due and charged during any quarter is not serviced fully within 90 days from the end of quarter. Whereas para D.8, now read and you will be in a position to see the difference. 12th of November 2021 circular, effective date is 31st of March 2022. Before 31st of March 2022, they need to implement this part. In case of interest payment in respect of term loans, an account will be classified as NPA if the interest applied at a specific rate remains overdue for more than 90 days. So that reference to the quarter is gone now. You don't need to see at the end of quarter, or you don't need to see for the quarter. What you need to see is that about remaining overdue for 90 days. So now you can switch off these lights as well. I don't know. You can switch off these as well. So if it is hindering you in this one, right? So what is happening now is you can have, or you will have this 90-day computation from previous 90 day as well as future 90 day as well. So everything is now on to 90-day norm, no reference to quarter, no reference to the end of year or the balance sheet date. In out of order guideline, earlier it was an end of day as a balance sheet date. That reference is also gone now. Let's see this one. See, in case where the outstanding balance in the principal operating account is less than the sanction limit or a drawing power, but there are no credits continuously for 90 days as on the date of balance sheet, right? See, there was a reference point of a balance sheet removed. Now it is if the outstanding balance in the CCOD account is less than the sanction limit or a drawing power, but credits are not enough to cover the interest debited during the previous 90-day period. So every day, see, 14th of September 2020 circular refers to that NPA process should be carried out on daily basis. So at the end of day, once the EOD process is being run, the NPA script will also be run at that point of time, and there will be a daily marking of NPAs. Once that is there, what you need to see to it that whether this software is reconfigured to incorporate these changes. Earlier, this part was looked into at the end of the balance sheet date, whereas now it is referring to previous 90 days. So every day night, the system will be checking for each account for last 90 days. Understand the difference. Earlier, this used to happen only at the quarter end where the balance sheet used to be prepared. If there are quarterly balance sheets prepared, right? So we need to understand this part, that whether system is configured enough for this one or not. 31st March happens to be the balance sheet date as well. So probably this year you may not find this much in detail, but as I have stated earlier, if you are doing concurrent audit, just see to it this in the month of April as well. Right. One of the excellent aspect is there on the 15th of February 2022 circular is this. This out of order definition is also applicable to loan products being offered as an overdraft facility. You all would have seen drop line OD cases, right? A lot of banks are providing that you can withdraw money at any point of time, you can deposit money at any point of time, but the DP into the account will be dropping down by a prescribed amount, and at the end of the tenure of that particular facility, the DP would be zero. Meaning thereby you need to keep on repaying this facility. But the problem that that was there in this facility was what the borrowers used to do. Let's say borrower is requiring 25 lakh, but the bank will be sanctioning 30 lakh. Right, 5 lakh they will put it up as a repayment. Once 30 lakh is released, they'll withdraw 5 lakh and they'll immediately deposit 5 lakh. So what used to happen was 5 lakh used to be considered as an against entire year's recovery. And these accounts were not getting classified as NPA, even though there were no repayment after 5 lakh. So reference to the quarter and kind of thing, right? But at that point of time, bankers used to say that this is an overdraft facility in normal sense. But for NP identification, he says that it is a term loan. You can't have benefit of both, right? It's a very convenient way of doing it that heads is also mine, tails is also mine, right? And the auditors used to be in the lurch. Because what happens is that when the RBI identifies such account as NPA, and then the auditor will get a letter. Then why you have not marked this account as NPA? Now this is for where the contention was, because the bankers used to say that this product is of a term loan. It has a reducing drop line DP. But when you counter them with a question that you issue checkbook, you can get the money from that account if the limit is available. You can deposit the money at any point of time. Can you do this into term loan? They will say no. Where have you classified this in the GL? So they will say overdraft. So why you want TL into consideration for this IRAC identification, IRAC provisions? So now it is perfectly clarified. Now what we need to see to it is whether as on 31st of March, are there any drop line cases where there are issues with respect to this recovery part? Please check this, whether system is reconfigured. Majority of banks had this product, drop line OD product, right? Select those cases, review it in a manual way, right? And see to it. If system is not configured, you can very well mention because 31st March is the last. As on current time, it is 31st of March. It may be extended as well. I am not sure of. But as on this date, it's there. Right. So understand the system first, understand the product, and then mention that or select it as a sample and mention it into an LFAR. Right. We need to plan in a very minute level this time because see, LFAR got changed last year, but last year was in COVID second wave at the peak. Right. So we did a remote audit, disclaimer audit, kind this audit, that audit. Actually, effectively, no audit was carried out the way we used to carry a year before. Rather even a year there before, because that at that point of time there was lockdown. Right, comprehensive audit is required, and meanwhile there are changes in the LFAR last year. Then there are changes into this one, and a lot of water has flown into this part, banking side. So the now entire contention or entire focus is onto the systems. If systems are working perfectly with respect to due and overdue, it's a game of due and overdue. So if you can get hold of due and overdue system, half of the work is done. Then what you need to see to it that whether system is perfectly working. But then there are issues that we are facing is that for due and overdue, they are manipulating the system. Not through system program, but through the fake transactions, fake changes in the master data, or accidental changes into master data, erroneous, whether intentional or unintentional, we don't want to deal into that one right now. I don't want to allege anyone as well. But these have been the cases. I will show you with example as well as with case study. What can go wrong if there is a change in certain place? And with all the explanation that yes, we need to understand these changes. What is more important into these changes are that RBI has now categorically clarified almost all dicey issues. One of the dicey issues that we used to face was this upgradation of NP account. Where the bankers used to say that the account is overdue by 95 days, the account turned into substandard. What they used to do, they used to recover somehow about equivalent amount of 6 days. And then they used to say that the critical overdue is recovered. So now the account is 89 days overdue and then hence we need to upgrade this account. Clearly no. RBI even in earlier circular also mentioned that arrears should have been recovered. But now the banker actually fed a lot of things into our mind that arrear means only critical overdue because it is as on 31st of March it is 89 day overdue and which is not falling under 90 day guideline. But thereafter a lot of queries went into the RBI as well and RBI this time clarified with stock and barrel. No ifs, no buts. And they clarified it with so precision that I'll just show you the next slide and then we'll come to this one. Interest and principal. Entire arrears of interest and principal as paid by the borrower. Understand this word. If there is housing loan and there is an OD or a CC account, right? And because of CC account, the housing loan is also getting marked as NPA. At that point of time, housing loan was working perfectly, but CC was having problem. Thereafter, housing loan also started showing stress. Already marked as NPA, they somehow could make that CC account operative and keeping that within the limit, and could upgrade that account based on CC account. But housing loan is now having an overdue portion. So what this revised guideline says, entire overdue of principal as well as interest as paid by the borrower, meaning thereby across all the facilities of the borrower. So what we need to do is, we need to check the movement of NPA report, because in any case we will be signing that movement of NPA certificate or this one statement, and from that we need to extract the cases and which accounts have got upgraded. Now those cases we need to look into detail, the effective date of upgradation. On the effective date of upgradation, generate an irregularity report, or through the system check that are there any accounts which were there into overdue at that point of time. If there is a single rupee overdue, then this account cannot be upgraded. If upgrade has happened and you have found something, mention it in your LFAR. See, again I am saying this, even 1st of July 2015 circular was also pretty clear. Only thing is that the interpretation was done by the bankers in a different way. This is only clarifying the position. So you can very well say that 1st of July 2015 circular was also mentioning word arrear. Right, and you can mention that into your LFAR that here in these cases the system did not work perfectly. The guidelines are so and so, so and so, so and so, but the system did not work perfectly into this side. Because in LFAR there is a question whether the upgradation is in line with the RBI guideline. See, now read the LFAR at least once again. You will be in a position to know that how much assurance that you are giving in, whether we have carried out that much work for giving an assurance or not. That is what is very important. Now, this is with respect to the internal system for proper and timely identification of NPA. For 14th of September 2020 circular, asset classification to be included as a day-end process, meaning thereby daily marking of NPA should be there. It should be a rule-based classification. You cannot say that I'll classify few accounts, I'll not classify few accounts. No, it has to be a rule-based classification. I would suggest you to do one exercise, especially those who are youngsters who can do it very fast and share it with the branch. So 2 or 3 youngsters can take a leave. They can come to the branch and they can just sit for 2 hours, max 2 hours. And that will be very helpful for all the members. I'll share you what you can do and it will do wonders with your reporting. What you need to do is, there are 3 circulars. 1st of October, that is master circular, and 2 clarifications. So first and the foremost thing is that you need to convert this entire 1st of October circular and you need to superimpose the changes over it. Right. So once now you have a complete master circular with you, newly updated with 2 circulars. Fair enough. Once that is there, what you need to do is you need to open an Excel file wherein you need to create 4 worksheets. First sheet downgrade, second sheet upgrade, third sheet provisioning, and fourth sheet revenue recognition. Downgrade, upgrade, provisioning, and revenue recognition. Dissect this entire circular into 4 parts. Copy paste all the paragraphs from that circular, copy paste all the paragraphs to Excel with para number. Fair enough? Or you can tag the changes as well with the dates and everything. What it will, at the end of the day, including restructuring provision. Right? So if you ask the question to the bank that whether your NPA system is optimized, they will always say yes. But when you check it, they'll say that yes, it is for term loan and CC account only. But when you see the conditions of downgrading, you will find at least 7 to 10 conditions where the account can be downgraded apart from TL, that is term loan, and the out of order status. Agree advance. Right? You have different type of this one. Mark to market. You have then NPI cases. Then you have cases of this FDOD, where the prescribed margin is not maintained. Gold loan, security, drastic reduction in security, 50%, 90%. Right? Stock statement not obtained. Then this renewal is not carried out. Restructuring done. See, understand how many eventualities or how many events are there where the account can be downgraded. Whether all the events have been included into the system or not. Because that is what the 14th of September as well as the other circulars say. So what we need to do is, we need to understand this aspect and we need to mention that and we need to test all these conditions. I am 10% sure that many of the conditions would not have been included into the system because there are certain issues with that. So what we need to mention is that these guidelines or these things are not there in the system. The second point that will come is that if it is not in the system, what is the alternative process that the bank is following? And that is what is precisely mentioned in 14th of September circular, that if there are any manual intervention, then there should be a board approved policy and the logs or the method prescribed with the signing authority or approving authority is required. See, your audit should contain all these parts. Otherwise, you will have a problem because now guidelines are pretty clear. Regulator is very aggressive now, very aggressive. So please don't be under that impression that we used to do it in a normal way up till now, and it will also go on that way. No. I'll share you one of the point that Vice President of an institute, Aniket, told me when I was in Hyderabad few days back. He said that when they went to RBI, RBI stated with RBI gave them a document whereby it was mentioned that the average time the auditor is spending on CBS during statutory audit, that is 4-day audit, 5-day audit, is 2 hours. So they were saying that what your auditors are doing. So Aniket said, we did say them that see, my auditors work on Excel. That is, they generate the data, then they process it into an Excel. So there is not the case that we do it directly on the system. But see, when auditor is given with certain set of data, to ignore a data or to overcome the effect of the data, you not require a solid evidence or solid rebuttal. So currently now regulator is having in mind that we are using very less amount or we are investing very less amount of time in CBS. So only way to counter is that make more use of CBS. I don't want to say that just go to one option then come back once again go to that, just keep your login intact. No, don't do that. If you are investing your time in the system, I will give you the list of commands, I will give you the list of processes that you can follow. Or what I have done is that I have done this entire audit process and mapped with the system commands. So that is also ready. Now you have everything. So let's now try and invest our time into this one. If your client is using Tally, you need to learn Tally, right? If your client is using SAP, you need to learn SAP. Now this client is using Finacle or TCS Banks or FlexCube. You need to learn that as well. It may take some time. You may not have that much access available at a given point of time. But at least you need to start. Right? Okay. There has to computation of provision should also be based on system rule. Now when you just open, create this file, that Excel file containing provisioning worksheet, you will find that there are n number of provisions required. Whether that is created into the system or not, how the same is being handled. Recognition and derecognition income to be system driven. Upgrade and downgrade to be handled by the system through STP, that is straight through process. Manual intervention only in exceptional cases after following due process. So please read the circular and your observation should be based on this circular. Clearly mentioned whenever you find anything. Refer to this circular, para number of that. and mention that the system is not working in line with this one. That is the best reporting that you can have. Include that in concurrent audit as well, right? So these were the few of the important part where I thought that the system of the bank would require to undergo an exhaustive change or an in-depth change. Once that is done, then only you can say that there is a compliance with the RBI prescribed guidelines. So now let's enter into the main part of the presentation, that is use of CBS for bank branch audit. Predominantly, there are three softwares in use right now. Finacle, FlexCube, and TCS banks. Finacle is currently having two active versions, Finacle 7 and Finacle 10. Most of the banks have now got migrated to 10, and other would also migrate to from 7 to 10. 10 is the latest version. Then comes FlexCube and then TCS banks. The other two are not used in India, used in other part of the world. That is Alnova Financial Solution and SAP Banking Services. So our entire discussion and everything would be based on these first three system and packages. You can say that mostly almost all banks, public sector, private sector, would be covered with this one, not the cooperative one. Cooperative have multiple option in software packages, right? So let's start with this one. This is what the entire presentation flow is all about. As I mentioned earlier, I will not be in a position to take this entire presentation, but what we'll do is we'll understand the important aspect. I'll share the entire presentation along with the other material that I stated earlier. So you can use it for the background material, or you can print it that way and you can keep it with you while going for an audit, right? We'll discuss parameters affecting NP identification. We'll discuss few of the case studies. We'll go through the second last part in brief, that is audit activity through CBS, LFAR and tax audit requirement. And if time permits, we'll go through the audit requirement in terms of revised LFAR. Because revised LFAR requires a lot of information to be gathered before starting an audit. So how to do it, how to work in that manner. Secondly, there is a revision in LFAR and there are certain points which require in-depth generation of data just to ascertain whether it is in line, there are no issues with the system or the processes, and you need to report it accordingly into that one. So there are massive changes into LFAR, and we can discuss that based on the availability of time. Parameters affecting NP identification. Ministry of Finance and Reserve Bank of India since years mentioning that it is mandatory for bank to identify the accounts through CBS or system instead of conventional method. CBS is like other software which work on GIGO principle, that is garbage in, garbage out. You cannot expect a magic through the system that when you have thrown a garbage into it and you expect that you will get an excellent result. No. If there are issues with transactions, if there are issues with the masters, then you can't expect that the system will behave in a proper manner or an excellent manner. You need to identify that where the issue might have been to, or if you find out any of the events or any of the situation, then you need to understand whether this might lead to some issue with NP identification or not. See, more or less all the banks have got this process automized. Systems are more or less working perfectly. Now the problem that the new set of problem is that system manipulation or the data manipulation is there to save an account turning into an NPA. So what we need to do is in owner of car KL01BG525. KL01BG525. Yeah, thank you. You can take the key from sir. Yeah. Yeah. So what happens is that we need to now understand that are there any events wherein there are issues with respect to some data, some masters, which might affect the automated NP identification process that is there embedded into the system, and which might go for a toss. It can be intentional, it can be unintentional. So don't enter into that arena that whether it was intentional, unintentional, so and so. Right? Let's start one by one. We'll discuss each point. First and the foremost thing is that discrepancy in setting up of EMI or installment. Now, I would like you to prepare again some youngster who is here. Just start making note of one of the point that I will be telling you, but do it for entire group, right? Because you can do it fast, and that's why I'm asking the youngsters to do it. It is applicable to all. What I am now explaining is the file or the template that we need to prepare before going for an audit. Because once we prepare the template, we work based on the template, we'll get an exciting results as well as perfect documentation for our auditing. Right? So what we need to do is we need to open an Excel worksheet. First 4 columns, right, would be customer ID, account number, name of customer, and type of facility, ODCC or term loan or kind of thing, right? For the cases where you have selected samples. Fair enough? Okay. Now I'll give you list of columns to be prepared, and I'll not tell you everything right now. I'll tell you few right now, few afterwards. So you need to keep on adding into that your page. First and the foremost thing that you need to have into that Excel file is what is the amount of installment as per system. Another column, amount of installment as per sanction letter. Periodicity of installment as per system, periodicity of installment as per sanction letter. Any difference between the two, right? You need to just tag it. Once you find that there is any difference or something is there, it will be a red flag for you to be checked in detail. So what you can do is you can give this to your subordinates or staff that you prepare this Excel file in this way, this way, this way. How to do it? The menu codes are mentioned at the below, right? And there will be an additional, as I have stated, I will give you the additional detailed ebook as well. Into that, this is in more detail, because in presentation I have limitation of including certain information. So once they prepare this file, it is 100% sure that he has worked on to, because he will be checking the system, he will be also be checking the sanction letters. Then wherever you find the difference, you need to ascertain why this is difference, whether this difference will have any impact on NP identification. Right? Understand this. If you have any impact on that onto an asset classification, then you need to test it from that perspective as well. Secondly, if any difference is there and there is no impact on, let's say, an NP identification, then also it becomes a point of your reporting. Fair enough? So currently what we discussed, installment as per CBS, installment as per sanction letter, periodicity, that is monthly, quarterly, what is the periodicity as per system, and periodicity as per sanction letter. And the difference column, or after all, there should be a difference column, right? Okay. Now let me tell you this in detail. Why it can create problem if there is discrepancy in setting up of EMI. Assuming that a borrower has got a sanction letter of mentioning installment amount as 30,000 rupees. Whereas in system it is set up as 25,000 rupees with longer period of loan expiry. Right? What will happen, assuming that the repayment starts from April onwards? So in the month of April, system will say that give me 25,000 rupees, because system is updated with 25,000. But the borrower got the sanction letter of 30,000. So he will make payment of 30,000 rupees. As against 25,000, the system got 30,000, so 5,000 is overflow. Fair enough? Same thing will happen in May and June. So 15,000 would be overflow as on 30th of June. Fair enough. From July onwards, the borrower is not making any payment. So what the system will say? What is the amount that is due? 25,000 from July. What is the repayment received from borrower? Nil. But what it will do is it will knock off the earlier available overflow amount of 15,000 rupees. So now it will say that 10,000 is overdue for July. August, nothing is paid, 25,000, that is 35,000 total overdue as on 31st of August, and 30th of September, you will add more, that is 60,000 is overdue. Whether the system will mark this account as NPA as on 30th of September where 60,000 is overdue with 90 days, no. Because as per system, the monthly is 25,000. So in and all, it's nearly a 75, near to the 75,000 is an amount that is required for NPA marking if it is overdue. But currently it is showing 60,000 only. Whereas in actual, do you feel that the account should have been marked as NPA? Right? Because July 31 days, August 31, and then 30. So 92. Rather, it should have been marked as NPA on 28th itself. 28th, 29th itself, right? So what we need to understand is we need to see to it that if there is a material difference between the setup of two things, there can be minor difference because what happens is in the sanction letter they mention many of the time 25,000 rupees where the system says that 24,891 or 981 kind of thing because that's for the convenience purpose. But nowadays that's in ECS or auto debit. So in that scenario, even though you don't need to draw the check. Earlier, what used to happen? There used to be PDCs. So if you have this kind of amount, it used to take a lot of time to write this in words. So what they used to do? They used to round it off, and the last installment they used to adjust. But now that cannot be the case as well. So if you find any issue into this one, just see to it from the perspective of NPA identification as well, right? Okay. System support available. You can go to option ACI, option E, repayment detail under Finacle. In TCS banks, you can go to the DLTL account services inquiry and account. Short and long inquiry options are also available under that one. Then comes the second type of loan wherein there is a multiple set EMI. That is, the EMIs are of multiple sets. That is, let's take an example of from first of for first 5 years, let's say EMI is 7,000 rupees. From 6th year onwards, the EMI would be 7,500 rupees, right? So that kind of loans are also available. But during our audit of one of the branch, we observed that in that branch, the issue that we faced was that the branch official set up this multiple set EMI in such a way that is, I'll give an example, that they set up that way that first 5 years the EMI would be of 5,000 rupees and from 6th year onwards the EMI would be of 1 lakh rupees. Now, can you expect the borrower to make the repayment who is making repayment at 5,000 rupees a month for first 5 years would be making payment of 1 lakh from 6th year onwards? That's not going to happen. Whereas when we saw the sanction letter, it was completely different one. 20,000, 25,000 or something kind of that. But so what that person would have done is that they have ensured that no account will go as NPA. At least for 5 years. Thereafter, he will not be there as a manager. So he will get shifted to somewhere else. It will be someone else baby. Right. So what happens is that whenever you find that there are overflows into the account, right, don't get this false notion into your mind that this overflow is because of the excess repayment. There may be the cases. I don't want to say that all borrowers are bad, right? Rather, because of few good borrowers, the banks in the country is earning, right? Today only, I think Vijay Mallya wished FP only to everyone through Twitter. And if you go through the timeline, this one, replies, everyone is mentioning happy only for you because it's not happy only for SBI. Almost everyone is mentioning that. Right. So that was on a lighter note. The point what we need to understand is this, that whenever we find that there is an excess repayment, whether excess repayment is properly computed or not. So whether the setup is properly done and the excess that is appearing is correct or not. So as I stated earlier, I am reiterating that it is now the game of due and overdue. You need to have mastery over it now, due and overdue. That's it. Understand whether the amount that is getting due is properly computed and whether the overdue amount is getting properly computed in the system. And that will only give you the perfect result with respect to the NP identification or the automation system. System might be perfectly set up, but the data might create problem. Let's understand with this example. This is an excellent case wherein, let's say, the account is turning into NPA almost, let's say, 89-day overdue with continuous excess of drawing power. With an example, we'll understand. The drawing power that is assigned to the account is 1 lakh rupees, facilities of 1 lakh. The balance is continuously in excess of 1 lakh to the tune maximum of 1,15,000. It is 89th day today. So if this remains as a 90-day as well, the same position, then the account will turn into NPA because of that out of order condition. That continuously, if you are going beyond your limit, the account will turn into NPA. So now what happens is, today, someone is changing the system, changing from 1 lakh rupees DP and SL to 1,25,000. So now on the day end process, what the system will do? System will check whether 1,15,000 is in excess of 1,25,000. Answer is no. Meaning thereby account is within the limit. See, earlier when we were very small, we were told with that story that there are two lines. You need to make the other line the bigger one without rubbing off the earlier one or the any existing lines. So what you used to do, you used to draw, or you need to connect the earlier line with the longer portions. Once you do that, what will happen in current scenario also? Recovery is not coming. So what I can do is I can change the limit itself. Now, assuming that if an auditor asks you or ask the branch official why you have changed the limit and or shows the sanction letter for the same, then probably you may get an answer that it was erroneously done in one of the account because we actually wanted to do it some other account. So if that is an error, you need to ignore it. Once you ignore it, just test it whether because of this error, this account would have turned into NPA. If yes, mention it. Also mention that because of this error this has occurred and there has to have a better control over this one, the changes in the limit. You are also aware about the fact such errors cannot happen, even the limit change and that to a maker-checker system. But what you need to do is you need to invest your time where it is required most. There is an excellent command in Finacle, ACL-HM, Account Limit History Maintenance. It's an account by account limit history, current information as well as history. Use that command. Only limitation is it's an account by account. You can't get it for a period for all accounts, right? So use that part. You need to check history of SL first. That is because you can do only one at a time. So you can check SL, that is S and D. So you need to enter an account number, check with S, F4 and just check it, D, F4. So you'll get all the changes in SL. So now coming back to that Excel file, right? You have a page available. Into that add a column. What is the SL as per sanction letter? What is the SL as per system? What is the maximum DP that is available as per sanction letter? What is the maximum DP that was given in the system? System is configured, almost all systems are configured in such a way that then it will be a minimum of SL and DP. So if your SL is 1 lakh and your DP is 1 crore, then also the system will allow you only 1 lakh. But your SL is 1 lakh and DP is coming to 50,000 only, then the system will allow you only 50,000. So in that scenario, what will happen is that assuming that we are taking case of 1 lakh, 1,25,000, where DP is generally higher than the SL, at least on the updation side, effectively you get only the least of both as a limit. So what will happen if only a SL is changed? They, let's say they have not touched upon the DP part, because DP is anyways every month on month, because of stock statement, book date statement, they have updated the system. That is, all the stocks, not a single account will have a less stock statement. Even though there is no inventory as on 31st of March as per balance sheet, you will find some stock would be there 2 days before. We are all aware with this one. We need to mention all these observations in the monitoring as well as the other part of this one as well. But in that scenario, what will happen? Even if you change only SL, you will be in a position to get the better limit. So our Excel file should also contain the part, are there any changes into SL during the period? If so, first and the foremost thing what we need to do is, we need to ask for the sanction letter. Once we get the sanction letter, we need to check it for how many days the new SL is required to be done. Moreover, understand this. If you find that this kind of convenient sanction letters are appearing, that on the 89th day they also have a sanction letter, mention it in your audit report, stating that this account was 89 days overdue. Because of this additional facility, this account got saved with this one. There was no economic visible benefit or kind of anything. You can mention very well in your audit report, irrespective of the fact whether they have the sanction letter available or not available. Right? Same set of excellent command is available in TCS banks as well, where you need to go to the deposit CCOD account servicing and interest rate history. Though it is named as interest rate history, it contains DP history as well as SL history as well. Right? Fair enough? So that Excel also file you are mentioning the column details, right? Then comes the moratorium. Moratorium can be given into the system through month, days, year, or you can give a moratorium through future dates. That is, you say that your installment will start from, let's say, after 3 months. So first of, let's say, April 2022. Kind of thing, right? Your installment, your interest will start from 1st of July 2022. So there are 3 possibilities: moratorium in period, moratorium through future date in repayment, and moratorium in interest through future date. Again, come back to that Excel file. We need to include these all 3 parts. What is there into the system? What is there into the sanction letter? What will happen is, if I got 3 months of moratorium as per sanction letter, but while setting up the system, someone has mentioned 1 year and 3 months, or 5 months, or 6 months, then what will happen is, system will not mark any amount as due. Whereas the borrower will make payment or will not make payment. And that will have an impact across the board from that point onward to all the installments. Because you have cushion of 2 months a due amount from that side. So we need to understand this, and our cross check point should be loan expiry date. What is the loan expiry date? See, if the installment is matching, interest is matching, start date is matching, then the loan expiry should also match. Otherwise, what will happen if some changes have been made into the system, loan expiry would not match with our sanction letter. So important parts, you need to check 4 to 5 parts: start date, end date, interest rate, installment amount. Whether everything is matching with the system or not. At that point of time, you can say that yes, at least the master data is properly fed into the system. In how many accounts you need to do? In all accounts that you are selecting a sample. How to select sample? That is also almost 95% of the method is mentioned in LFR itself now. 10% 10 crore, top 5 standard accounts, quick mortality accounts. Right? Credit rating is applicable or not. Stock statement and stock audit required but not carried out, or carried out but no thing has been made. So all such cases, you need to comment one thing or the other, and whatever list of accounts that you select, whichever accounts you select, you need to mention it in LFAR that these accounts I have selected. The format is made in such a way that once you enter the branch figures and the amount, the accounts that you have verified with the balance as on 31st of March, that table will compute that what is the percentage of verification that you have carried out. I am expecting a reply from Reserve Bank of India in 1 year down the line. They will compile everything and then they will show it as an average that your auditors are not even verifying 15% of the value. Not far away. Now everything is in the system. So what they need to do is they need to ask the banks that you compile everything. In any case, they do the consolidation of LFR and then it is a system. And what they'll do is they'll simply say that they'll divide it and they'll show the data on our face only. Simple. If someone asks me that what is the ideal percentage, see, there is no straight answer to this one, but what I can suggest is this: at least verify 50%, at least. If more, that is the best one. And if you find that only one account is consisting of 50%, then don't limit yourself only to the one account. You need to select sample which is representative of all type, all bucket size, right, and all eventualities. So you need to select if possible. I am not saying that you need to work in this manner. All type of account, at least one type, one account you need to see per type, at least. The accounts which are more than 10%, in any case, you need to check all. Plus, not only all, you need to do a transaction detailing as well. Very important one. Transaction detailing is required for the accounts which are beyond threshold. For below threshold, you can have a process check or control check. So, which kind of document you can show to any of the regulator if they comes up that whether process or control check was carried out? Your Excel sheet, right? See, understand. You are also preparing document. You are also preparing a dashboard, and you are also making that your people who you have deployed are also working. Right. So that thing also we can do it. So this is on incorrect moratorium period. Same way the installment start date is future date and interest demand date is future date. The three part we have already discussed. Then comes the refacement without reporting it as reschedulement or a restructuring. Again, let's come back to this Excel sheet. Before that, we need to understand what is reschedulement or a restructuring. Refer to the Reserve Bank of India Master Circular where there is a specific definition given for the restructuring. Because of the economic issues or some issues of repayment to the borrower is not in a position to make payment, or borrower is requesting for three parts: change in rate of interest, that is reduction in rate of interest, or second part, that is asking for extension of loan, or third part, asking for reduction in EMI. Because of that aspect, weakness, credit weakness, then that will be considered as a restructured account. Once you have a restructuring confirmed, then you need to report it as a restructured account under a statement of list of restructured account where we need to sign as well. The problem is the moment you do this account restructuring, the account should undergo asset classification one notch down, that is degradation. But there have been cases that we have observed wherein the borrowers were facilitated with all kind of this thing without even updating it as a restructuring. So thereby, even the restructuring was carried out. The borrower got the benefit that he wanted to have, plus the asset classification was retained. Asset classification can be retained only when the Reserve Bank of India gives specific direction or there are specific guidelines available right, to retain the asset classification. Then only you can have that benefit. Otherwise, you cannot have a benefit of retention of asset classification in case of restructuring. So what we need to do in our Excel file, you need to see three aspects: loan expiry date, second one is installment amount change, third is interest rate change. So first two, installment amount as well as loan expiry, would be available through account master. Any system, account master. So in Finacle you can access through ACI. In TCS banks you can go to the account master in deposit CCOD or DLTL. In this case DLTL would be there. And the third part is interest rate changes. So for interest rate changes, what we need to do is we need to go through the command called INTTM in Finacle, that is interest table master maintenance. Or if INTTM is not working in your login, you can use the command called INTTI in Finacle. In TCS banks, you can use the interest rate history under DLTL and account services. Just check, are there any changes in the interest rate or not? Here I would like to inform you one part. When you compare the output available in TCS banks and Finacle for interest rate change, there is a difference. So you should be aware of this part as well. In Finacle, you can find entry into INTTM output or INTTI output only when there is a change in the interest table master. Meaning thereby, if let's say the interest table master earlier was MCLR plus 3% table, now the table itself is changed to MCLR plus 2% table. Then only you will find entry into this INTTM. Whereas in TCS banks, you will find all changes. That is, it tracks only effective rate change into this reporting. Meaning thereby, if there are changes due to change in the MCLR, it will also come there. So what you need to do is, first and the foremost thing is that you need to track all the changes in MCLR happened in that bank during your audit period. It is available on website as well. Or you can ask the bank, or even in closing instruction also probably you will find this information. So in case you are working on a TCS banks platform, then what you need to do is you need to map that if let's say on 2nd of September it is saying that the interest rate is now from 10% to 9.5%. Earlier rate was 10 to from 2nd of September the rate of for borrower is 9.5, let's say. So meaning thereby there is reduction of 0.5. Whether on 2nd of September there was a reduction in MCLR exactly of 0.5. If so, you can say that yes, this change is accordingly due to the change in MCLR. But if that is not matching, then you can say that there is some manual entry into this one to change the rate of interest. Then you need to have the sanction copy first. Clear to everyone? Right? Okay. So this is what we need to include it on Excel file. That any change into installment, any change into date of expiry, any change into interest rate, whether that is turning into restructuring guidelines or not. Right? Then comes a difficult one and most widely used, or I can say misused. Fictitious credit to office account, inter-branch account. What happens is that when we refer to the out of order guidelines, it says that account can be classified as out of order in three, you can say three aspects. One, it is continuously in overdrawn status, right? So that is normal. Second, it is there is no credit in the account. And third, the credits are there, but the credits are not sufficient enough to cover the debits, and more particularly interest debits. Fair enough. Now in that scenario, what will happen is that what you see now is for the second and the third link is credit turnover in the account. Right. Now with respect to credit turnover in the account, as you are also aware of this one, that the IRAC guideline you are also aware of, the software guy is also aware of, the software is aware of, and the branch officials are also aware of. They get a report that these are the accounts which might turn into NPA if you don't do any action in next 5 days, 3 days, 2 days, 1 day, kind of thing. So they are also aware of. Let me tell you an example. If account is there which is turning into NPA because of insufficient credit, either no credit or credit is not sufficient to cover debits. So an interest is a transaction is originated from office account, let's say suspense account debit, to the borrower account, and immediately the transaction got reversed, stating that wrong entry reversal. So even if someone find this one that why this entry was posted, you will get an answer. It was a wrong entry that was reversed. So in net there is no impact on transaction or account balance, but yes, there is an impact on asset classification. See, understand now. You need to now understand the psyche of system as well as the person handling the system. If you have everything set, then also people will find out certain loopholes and they try and circumvent the system. Right. So what I would like to say is this, that check the accounts for transaction as well. Now when I say that check the account for transaction, I mean to say this, that you need to now start cultivating habit of reading the account statement. There is a pattern available in all the statements. You should be in a position to carve out based on a pattern that this account requires further scrutiny, further detailing. There are patterns like zigzag pattern, Z pattern. There are patterns like one to many. That is multiple source credit is coming and only one place it is going. Multiple debits are there with one source of money. Kind of cash deposit and RTGS, cash withdrawal from an RTGS entry, cash deposit from one location, cash withdrawal from other location. Right? You need to understand the type of account statement, and then you should be in a position to map the business of borrower. Let's say if it is an IT company, not into the retail business, only into the business of providing services to the corporates, can you expect cash deposit into this account? See, understand, everything should be on your mind because you can't invest much of the time during verifying the account statement. Moreover, the LFAR says that for the accounts which are beyond threshold limit, you need to do the transaction detailing. Now, when I say that 10% or 10 crore account, meaning thereby the account will also be the huge of size. So, when you verify the transaction, it is not of a minute job. So, in that scenario, you need to simply scroll through the transaction, just see to it. You can't invest much time into this one. But you should be in a position to understand that if these are the type of transaction, something is there amiss, just make a note of it, keep it aside. Verify other account and then re-verify that with some detailed this one. But you should be in a position to identify that case. See, when you go to your general practitioner or a MBBS doctor, in initial time, nowadays because of COVID, they don't want you to be near to them. Earlier, the first thing that my doctor does is this. He's an old school doctor, right? He'll keep it only for 10 seconds. There is a mathematics for this one. In 10 seconds, he'll compute the pulses and then he'll multiply with 6 to know that what is my pulse rate right now. And thereafter, he'll be talking to me, but at the same time, he'll be doing this activity. So he'll be in a position to understand whether everything is normal with respect to this aspect. Then he'll check your chest or your this throat. These are the basic things that they do, but they'll be in a position to identify immediately something is amiss. Then the old school doctors I am referring to, they'll ask you to do the test. The new school doctors say that first you do the test and then come. There is a reason to that as well. They are not wrong in that side. Now there are issues with medical legal cases and the same thing we are also facing. So they create their documentation. Meaning thereby they say that you got us this report, we read this report And we are relying on a third-party system, that is the laboratory system. What things are going on in laboratory, if you are aware of, that is the best thing. Else, ensure that you don't know such kind of thing. There are statistical sampling method is also going on in lab. Right? Your future is determined, or probably your course of action or a medical action is determined on that one. Exactly the same is happening with us as well. We are relying on certain set of reports, presuming that the system is perfect, presuming that the report generated is also perfect, and then we are desisting with our practices, age-old practice of testing it in our own way. Please don't desist with that one. Keep that one. What we used to do earlier, even though it was manual, we used to run through pages for the ledgers. And we used to check the transaction as well. When my father was doing audit, right, he used to say that there used to be A0 size statements. So the big table used to be there. So you can start from here, you'll end it up at somewhere else, like a newspaper. Now we are coming into the digital era. You need to be techno-savvy now. Secondly, you need to prepare your documentation. And for documentation, I am referring to these aspects. Not only this. What I would say is this, go through the LFAR requirement, ask each and every type of data. I am 100% sure you won't get it. Then you will say that, sir, what is the fun in asking if we are not going to get it? Document it. Send it through email that we want this data. Keep your audit requirements of 30 page, 40 page, whatever is there. Mention everything. If possible, tag it with your respective audit reporting as well. That this is required in terms of LFAR point number so and so, so and so, so and so. Tell them, mention it in one by one responses. I am also sure you won't get everything what I am speaking. It's very easy to speak from a podium. I have been into the concurrent audit position, internal audit position, statutory branch audit and statutory sample audit. So I know what is my worth when I go for a concurrent audit. I can't expect the luxury of central statutory auditor, right, of getting data and kind of thing, right? But the thing is that we need to start creating document. If you don't get a document or a data, document means include data, you need to ask them to mention that it is not possible so and so, so and so, so and so, whatever they want to mention. Whatever response that you have got, include it into your audit report, stating that we requested for this data in term to verify this aspect. However, we were not provided with this data, or the response that we got is so and so. However, so first and foremost thing you need to mention, in view of this, we are not in a position to offer our remarks on these aspects. However, as an alternative process, we carried out this audit in this way. That is, we selected sample of so and so, so and so, so and so. We verified this aspect, and then the observation. We verify, we observed this one, or we did not find any material discrepancy or kind of thing. So this is what you are starting with, what process you have carried out, but that is possible only when you have a document trail available. That is why email or document is required. Assuming that you don't get any response, then you need to open with your another weapon, that is negative confirmation. Send a second email stating that refer to our email and our subsequent discussions or whatever is the fact of the matter. We have been informed the following. Mention everything what you have been informed, that this is not available, this is not available, what verbatim mention. This is for your confirmation so that we can rely on the same for our audit purpose. Do let us know if anything is factually incorrect into this one by so and so date or so and so time. Else we'll presume that whatever is mentioned here is factually correct, and we will base our opinions and audit process on the same. It is known as negative confirmation. Don't start with negative confirmation, start with the positive part. And then, once you conclude your audit, obtain an MR letter as well. So you have now double confirmation. But don't give your only report, or don't report only through the disclaimers. That is not a good practice. That is not at all a healthy practice. Right? If you only go with the disclaimer part, then what is the need of an audit? You also have an alternative process ready. yes, in case if something is not, there is no possibility of alternate process, then you can very well mention that this is the alternate process is not available, whatever is the matter of the fact. Right. So this is on fictitious office account credit, from where you can find transaction detailing, office account review, or when you find that there are some accounts where there is some weakness or some credit is not appearing, then select those accounts and check suddenly from where the amount came. Use a command called ACLI, account ledger inquiry. It is exactly the same as we use in Tally DAL, display account ledger. Friend of auditor, ACLI. Right, you should be investing more time into ACLI. It is as powerful as Tally. In Tally, when you press after DAL, you find list of transactions. You press enter and you go to the voucher entry stage. In here, you need to press Control E, or in case of the Finacle 10, there are buttons there against each, besides each line item. You just need to press that and you will find the voucher entry. What is debited, what is credited. Right. In case of TCS banks, you have an option of reviewing transaction based on specific tags or a pattern through deposit CCOD account inquiry transaction and DLTL account and services inquiry and transactions. There is short inquiry available, there is long inquiry available. Under the long inquiry, you also have a feature of selecting transaction based on cash, non-financial transactions. So all kind of narrative would be available into this part. Then comes round tripping. One account is debited, other accounts are credited. Say, let's say X, Y, and Z accounts are nearing to the overdue and nearing to the NPA because of low credit turnover. So A's account got debited. It got credited to X account. A and XYZ are not related. From X account to Y, Y account to Z, and all the entire set of from Z to A, and everywhere at the time of reversal it is mentioned wrong enter reversed. A, who is not a person related to X, Y, or Z, might complain it to the bank if the money is not received back, that you have debited my account with, let's say, 10 lakh of rupees. But before he reaches the branch, he will get another message that the transaction is reversed. So his least concern, there might be some error. But because of that, three accounts got saved. Right? So understand, are there any cases wherein just for the credit turnover, the transactions are being routed through? Again, transaction detailing is required. The source can be, I'm now just giving you some hint. Source can be generate, or you just get an excess of SMA accounts. SMA accounts, probable NPA accounts, different type of reports are available. Not of a quarter end, in between the month, any time in between the month, and just compare it that account. And when you find that during the month, if you are finding that some account might turn into NPA with so and so date, right? And if you find that this account did not turn into NPA, just check what is the transaction which saved this account turning into NPA, and then broaden your horizon there. Fictitious credit was there, how the money came through, was there a new loan sanction for the old loan, right? Is there any issue of a round tripping? Is there any credit originating through TODs? Right? These are the points that we need to be looking into, and mention everything, what the process that you have carried out. That we selected a sample of so and so date probable NPA report, and then we looked into the detail of top 5 accounts or whatever you want to do, and we have carried out this process. Just narrate it. See, you don't need to do a fancy documentation. We as a small size firm, my firm is also small size, so I am like you only. We don't have time, we don't have energy, we don't have resources, we don't have cost, right, for maintaining exhaustive documents. Whatever we are doing, we are also having proper documentation. Only thing is that we don't have proper tagging available. That this is as per SA so and so, so and so. Don't get frightened with the SA numbers. I don't know any SA numbers. I don't have anything marked up. but I have books available. I can very well check it. What is required is I am aware of that these documents are required to be maintained. Right? Only thing is that the tagging is missing. Let's do the tagging. Let's make a document. See, if you have this exhaustive Excel file available, can anyone tell you that you have not worked? Can anyone? If we have not worked, how can we have the information from multiple sources? Right? Then comes the temporary overdraft. Again, a very risky proposition for the auditors to verify. If you happen to be the auditor where the FINACL is there, I would suggest you to generate a report called TOD-RP, TOD Register Printing. It's an excellent report. You need to first understand what is TOD-RP, and there are some intricacies of TOD-RP, and you need to understand that first. TODs are of many types. What we need to track is TOD-MN event, that is TOD manual event, right? That is the TOD that we need to be looking into. Then comes what are the other type of TOD? TOD single, TOD ad hoc, TOD running, SAR. Single TOD means the TOD which is given at the time of processing of transaction, where limit is not available, and only to get this transaction processed a TOD is given. It is not given as a limit. It is given as facility only to ensure this transaction get processed through. Fair enough? So after this transaction, if some amount comes in into the account, you don't get an additional facility amount. What you get is you got your transaction processed. Fair enough? In case of an ad hoc, the limit can go up to 90 days. In running case, you get a facility of about 4 days, 5 days, 7 days kind of thing. It depends on how the bank would like to set up into the system. Fair enough? Right. TOD report, once you need to generate 2 reports. So single you can ignore. If you want to generate, you can generate single as well. What you need to do is you need to generate predominantly 2 reports with TOD-MN. TOD-MN period, you need to mention your audit period, TOD-MN with with A ad hoc, with R running. So 2 separate reports are required. Convert that report into an Excel. It's a text report, convert it into an Excel. Just apply the pivot table or make a pivot table with a count. That in how many customers are there. First, you will get the list of customers and the with count, how many times he got a TOD. Or you can use the formula sum as well on number of days TOD. That is, if the TOD is for 5 days, right, then you can just aggregate the numbers as well. Right. In one of the bank, we observed that, let's say if bank is working for 250 days in a year, the person got TOD for almost 245 days. Meaning thereby every day he used to come to the branch, used to enjoy the tea of the bank, and he used to go with the TOD every day morning. Now this is blatant misuse of systems. In LFR also you need to mention, are there any instances of frequent TODs? In that scenario, this report observation would also be handy with you. One more thing is that with this report you can find that whether the branch manager has exceeded his brief or the limit. When the limit is prescribed, then you need to see whether the sanction of higher authority is available or not. Moreover, you need to see to it, are there any aberrations into the TOD? Aberration means I have during my one of the audit observed that in one of the bank, the branch had given a TOD of 11 lakh crore. 11 lakh crore. The bank's balance sheet size was less than 1 lakh crore. So how it can happen? So when we went into detail, we found that instead of mentioning amount, they mentioned the account number. These are also the fallouts of the system where there are no limits given in certain place, because if you say, then the software developer will give the limit, right? Then I was working as a central statutory auditor, so the moment we find something, our heads start rolling in. How many other fellows are there who have given this kind of benefit? So we run through the query through the system and we found about 22 cases across India, ranging from 11 lakh crore to 22 lakh crore. Same case, account number is mentioned in amount. Just imagine. And just imagine if this would have been on the last day of balance sheet, what will be there in the CRAR? Everything will go for the toss. See, that's why I'm using system since 1989 when I was 6 years old. From day one, my father told me, never ever rely on system. Keep this in your head. Start challenging the system right from beginning. Meaning there were the moment you find that the system is perfect, you feel that everything that the system does is perfect. You have seen in recent income tax systems as well, right? So now read that statement that I made earlier and my father told me. My office is completely computerized since 1989. My father invested in both myself and my brother, right? We are learning systems since that time. So he said first thing, never ever rely on systems. Start challenging the system because the softwares are also made by the human being. In income tax, we got the refund when there was a liability to be paid on interest count. But everything can happen with income tax now. If you file one return, you will get 2 acknowledgements. So everything can happen. So now you can understand. And now it is the turn of MCA. We have finished up this timeline. Now MCA is behaving in this manner. And GST is very well there. I am at the top. Right? So that's the life of an auditor now, or the chartered accountant now. You're more like working through the system just to get the return file. Nobody is now thinking of what is correct. Not a single chartered accountant is now thinking what is correct as per provisions. Everyone wants that at least my return should go. What kind of sorry state of affair we are into? Bizarre. In one of our clients' case, CBCR filing documentation was required to be filed before filing of return. My return was ready as on 31st of January. The system was not saving anything. Nothing was to be done, can be done through the system for CBCR filing 3CEAA. I have extended the filing of return by 2 months. And I have paid interest for that as well. Just imagine if we tell to the German parent company, just because we have a shoddy system where if the return is not getting uploaded, we cannot file a return because we need to file a form before that, and that form is not ready or system is not accepting. I had 2 WebEx call with Infosys guys just for one return, and that too after filing 4 to 5 grievances. And thereafter I could file. Now the form, excellent part was this. Just understand. Part A, Part B and Part C is there. Part B filing part, you can, even if you do it everything very fast, then also it takes 25 minutes and you cannot save in between. The moment you save it, go to the Part C, and if you want to go back to the Part B, everything vanishes. We called a person from Vadodara, that is 120 kilometers away from my office, with a digital signature of a director, probably in a thought process that if I completed everything in one session, it will be over. He spent about 3,000, 4,000 rupees in this commutation, that too on Sunday, and we applied digital signature, everything was blank. We tried 5 times on that day. So the time invested, everything gone. So what I believe is this, everyone's story is there, right? What I believe is this, that when you work with the system, never ever rely on system. Have your processes ready. See, the second point that we are facing is that we are now heavily hinged onto the system, so the softwares, ready-made softwares. And that has actually impacted our analytical process and the preparation in certain spreadsheets or even working part. What you do is, whether the what is the tax coming up into that from that software, just inform it to the client. Where can we apply our mind? For specifically for that reason, that does not mean that we don't use software. We do use software, but we also prepare our statement of total income template every year. Every year, I have statement of total income prepared based on the this Finance Act right from 1989. Still, I have. At that point of time, we used to use frameworks where the software used very less by certain people. It was like Lotus, you can say. There at that point of time, it used to be Lotus. Still, I can access that. So point is this: why we are doing it? Because then we will be in a position to read that again and again the Finance Act. Otherwise, if anything software is going to do, gone are the days that you can enjoy the facility, enjoy the fruits of this one, that as in chartered accountant, everyone will come to you. Now people are getting this return file in 300 rupees. How many? 300. Will you be in a position to do that in 300 rupees? If yes, do it. Otherwise, everything is coming online. That is, someone would be sitting somewhere, you just provide them a data, they'll file anything. But then they'll not respond to any of the 143 1A queries or anything. That is in your, but what the person will, that the taxpayer will feel, I have only salary return, and you ask lot of things, bank account, this detail, that detail, ye, wo, right? So they say no, this guy is not asking. He is not asked. He'll mention something else. So when you refer to the system, always challenge the system. Then comes default bills. LC got default, BG got invoked. Instead of debiting to CC account or an OD account, current account of wherever, whatever the case may be, they have opened a new account. So now you cannot have a proper overdue position because it is now considered as a separate account. Or in many of the banks, they do debit into office accounts. In that scenario also, you don't get this proper, overdue amount. RBI has categorically stated that in case of an invocation of BG or an devolvement of LC, the amount should be debited to the operative account, or that is where this operating loan account is not there, the current account. Right? Then comes multiple cost type. It is not that much important now because of the UCIC. Project loans. Updation recording of DCCO dates. That is date of commencement of commercial operations. Capturing, see, one of the condition of account turning into NPA is this, that is the DCCO dates have not been updated. I welcome the next faculty, Dhananjay as well. He'll be taking through all this aspect, nitty-gritty of NPA and IRAC norms. So what happens is that even if the repayment is there, the DCCO dates have not been updated into the system. Now what the RBI guidelines say, everything should be automized. Now most of the banks, they don't have this condition into the system where just because the date is not mentioned, the account is turning into NPA. So what we need to understand is the one that I have stated earlier, that we need to dissect the circular, we need to see the events, whether all the events have been captured into the system. If not, whether bank has a document available that these are the conditions which we cannot include into our system. However, this is an alternative process that we have carried out. Right, just because you could not update the DCCO dates or did not achieve it, the project loan, right, the account might turn into an NPA. If you are not having it in the system, there might be a loss of this tracking. So what you need to do is you need to first ascertain the project loans into the branch and need to see that whether the dates have been properly captured. Assuming that dates are not captured, then you need to manually compute as per the provisions, IRAC provisions. If you find that no, with this date the account is not turning into NPA, then your observation will remain to that extent that this date is not updated. But if that is turning into NPA, then you need to report on both the counts, that the system is not capable enough and this NPA part. Right. So these were the point on NPA identification. I'll quickly go through one or two case studies. I'll show you whatever I have explained it to you through this case studies which we observed. This was the case of sanctioning of a new loan for existing loan. So 4 accounts were there where the customer was not in a position to repay the loans. So 4 new loans were sanctioned. So if you compare the total exposure, net exposure as on pre and post, it was exactly the same. Meaning thereby 1 crore 44 lakh 50,000 was the net increase due to sanctioning of a new loan, and exactly the same was the change in the pre and the post. So we can very well say that there was not a single rupee brought in by the customer for repayment of existing loan. And ironically, while glancing through the document, we found a note, internal note, not signed one, but the draft. They generally prepare the draft and keep it. In that, it was mentioned that we need to sanction new loans so that the earlier loans can be repaid. As blatant as that. This was the case where the current account got a TOD. Current account did not make payment after 22nd of March. The current account was with debit balance, but when we looked into that after getting TOD, what the current account has, the person having that current account has done, there was immediately a debit and credit to the borrower account, which was nearing to 90 days. So the borrower account was saved and the current account is having an overdue of 9 days. So that can also not be considered as NPA. This was the case of a manipulation in credit as well. You can see that on your screen, right? 9 crore debit, 9 crore credit, 3 crore debit, 3 crore credit. Within 4 minutes or 5 minutes, there are transactions of about 100 crores. CC account to current account, CC account to current account. Zigzag pattern, right? There are interesting set of people who debit the same account and credit the same account as well. So if you only rely on the report named the ATOR in Finacle, right, will not be in a position to judge that one. ATOR you can use up to that extent where the credit summation is less than the interest debit. That's it. But don't say that just because ATOR is showing that amount is way beyond the debit, interest debit, you need to first check the veracity of the credit. Right. This was the case where the TOD was granted, immediately the cash withdrawal happened, and immediately after that, cash deposit was made into the CC account. Otherwise, when you have a cash transaction, there is a loss of audit trail. But in this case, we could find out through the teller. Within few seconds, only the same teller passed an entry for cash withdrawal and the same teller passed an entry for cash deposit, and there was a direct nexus available between the two. This was also the case of that, but it was crafted in a very perfect Hollywood style movie. This was the case where three accounts were there of a borrower which was not having any credit. Now there was if the credits are not would not have been there, the accounts would have turned into NPA. So the borrower deposited some amount on 30th of March. The auditor of that branch was holding up the report till the last date. So we got a message that this auditor is not releasing the report. He is having some issue with respect to 3 accounts, and one page a cryptic note was received to us. The note was not containing any information, any message or any specific this one. But then we understood that there is something amiss. But when we saw the account statement, we found that yes, there was cash deposit. At times it happens because when you have a lot of pressure, they try and squeeze whatever money that the borrower is having during the end process. That's normal. The problem started when we got this one, that why the auditor is holding up. There might be something which is not meeting the eyes. So almost we have said that to the banker that fair enough, that's okay. You can go ahead, you don't need to mark this account as NPA. But then we thought that no, something would be there. So we started digging into it. When we found that the 3 accounts were there, started with the teller account. We started with the jotting of all the transactions with date and time and debit credit. Once we have done this, we found that some anomalies are there. The branch timing is usually 3:34, and the branch had closed the cash at 5:01. Right? All the cash which was available with teller was transferred to the vault, and that is effectively the transaction which says that the day transaction of cash is completed. At 5:14, we had a set of cash pouring in to the tune of 48 lakh rupees in various about 8 transactions, right, in 3 accounts. So once that pouring in started, we said fair enough, there might be the cases of late cash or the late recovery that came in. At least we got the money. That money is with the bank. But when we went further, we found that after even the banking hours, 2 customers were ready with the checks exactly of 48 lakh rupees. There are too much coincidences now here, right? And they withdrew the money as well at 5:27. In 4 minutes, the cashier could count the cash, could complete this entire process of verifying the fake note and everything, and could process the transaction as well. In 4 minutes, he had completed about 8 transactions, aggregating to 48 lakh rupees, and in 1 minute, he disbursed everything to 2 person. Fair enough, if a current account is having a balance, then he can very well withdraw. So we went to the current account to know that whether there is any balance. We found that there was not a single rupee balance in that account. Then how come they could withdraw? TOD. It's completely a fraud only. Misuse of everything. This whatever the things are available. Now eventually it ended up with 3 accounts as well as 2 accounts turning into NPA. Right. So please understand, whenever you find that at the fake end or at the immediately on that day when the account is turning into NPA and you find some cash, just check it. I don't want to say that you check it everything from this perspective. Don't have a jaunty side. Only when you find that there are some issues about this one, some documentation are there or something is there, then only do it. Don't see from that perspective that everything is bad. Right? Otherwise, you start thinking on a negative side. Right? You need to offer your unbiased opinion. Right? The last case study that we would like to discuss, and thereafter we can have few questions and we can then close this session. This was the case of a consortium account where the total exposure was about 7,500 crore. The account was an NPA account. The bank where we were auditing was having a 10% share of about 750 crore. The security that was total security that was available to for that consortium advance was 2,500 crores, and the bank's share was 250 crore. What has happened was this account became an NPA and there was an unsecured portion of 500 crores. So there will be an impact of provisioning on the unsecured portion of 500 crore accelerated provisioning. In system, they have updated security value as 2,500 crore instead of 250 crore, citing that this entire security is ours only. That's not going to be the case. Now, what has happened? There was no accelerated provision computed on the unsecured portion. And when you give an MOC for this amount, whatever figures that the bank would have thought of that will end up with this result would go haywire. So what we need to understand the Excel file, the one that I started you to make, you need to also include what is the security amount that is mentioned in sanction letter, or are there any subsequent valuation done with the security and whether the same is matching with the security updated into the system. Understand, in system many of the reports they don't have comma. So you need to apply the comma. Otherwise, probably 250 crore, 2,500 crore will not be in a position to understand. Right? So these were the points I wanted to share. I'll just show you a few of the aspects and then we'll close it down. You can prepare your question by that time. So this is now on. We'll see to it that audit activity through CBS, LFR and tax audit requirement. I'll explain you one slide and then you can understand the rest of the slide in that manner. It is prepared in the flow of LFAR verification. So it starts with the cash. What to verify is mentioned and source from where to verify it is mentioned. That in Finacle you can go it this way, in banks you can go it like this way, in FlexCube you can verify it this way, right? So you cannot now complain that you don't have menu codes for any of the system. You need to now perform, you need to now show that you have performed, right? So this is on cash, then it's balanced with RBI, SBI and other bank advances. See now whatever columns that I have stated you to make it in Excel, you will find it here in advances. Advances there are about 12 to 13 points that I have mentioned, that sanction limit, drawing power setup, from where to check. right? So what you can do is you can prepare a job card and give it to assign it to all your subordinates that you need to finish this one. You need to give the timeline as well. It should not happen that for 3 days you will be working on the same aspect. No, because we have a lot of work to do. Advances, then customer transaction masters, borrower account interest rate history, conduct of account and credit turnover, temporary overdraft, non-performing asset, interest report, right? This is all self-explanatory. I will not be in a position to take it in detail. I have included a few of the reports as well, that what is to be seen into this report, right? So this is an exception report. What you need to be looking into this exception report, what you will be looking into the irregularity report. Account where interest code is 0 or applicable as no if the bank is providing such reports. If not, then you can do that activity through advanced account filtering of interest rates, right? NP accounts. Now the last table, this last part is on this one, revised LFAR and how we can structure our audit planning with the use of system as well as data. So this is what important points only I kept it. 10% of outstanding of aggregate balance of fund based as well as non-fund based. This is a major change when compared with the earlier this one. So what you need to do is now you need to ascertain the FBN as well as NFB limit used. There is a classic point in LFAR. I have not included here, but when you read it, are there any NP accounts where there is an interchangeability of limit was observed? This is a clear-cut case of a window dressing. What branches used to do earlier, assuming that you have an LC development. So it will be from a non-fund based, it will become a fund based. Fair enough. So because of that event, the amount of LC, right, the limit would be free in LFP limit, right, because it is now shifted to FB side. It is in overdue state. So what bankers used to do, they used to invoke this provision of interchangeability of limit and they used to reduce the NFB limit and they used to transfer that limit to FB just as to ensure that it will not be appearing as overdue. What a novel way. And it used to be carried out since years. Glad that RBI has included this part into this one. Same way is the case for FCNRB. You have a state where you find a lot of NRI accounts. Read this part. It is very important to understand FCNRB. You cannot put FCNRB on an auto renewal mode because at the time of issuance of each FCNRB, you need to ensure that whether the person is still an NRI. Excellent point. But I would say that this point is good for concurrent auditors. For statutory auditor, how much justice you can give into this one, I am not sure. And this is highly misplaced one, minimum average balance. I don't know how come as a statutory auditor you will be working onto this one, but it's there, so you need to work on it. So I can't say anything onto that side. Any questions? No questions? My God. Not a single? Okay then. Thanks a lot. Hope I was able to explain the points in a proper manner, because if you don't ask me the question, then also I'll have a difficult situation to think it on that side. Yeah, close, right?
On behalf of Thiruvananthapuram branch of ICAI, I take this opportunity to conclude the first technical session with a formal vote of thanks. I thank Sri Kuntal Shah coming over here from Ahmedabad and giving an excellent presentation. The areas which he covered, such as NP identification parameters, office accounts, and case study are sure to bring value addition in our audit program. Thank you, sir, for giving us a walkthrough audit through the CBS Environment. Now I request our past chairman, C.A. Sridhar, to present a memento as a token of our gratitude. Thank you, sir. We shall break for 10 minutes and shall reassemble by 12 o'clock for the inaugural session. Thank you all.
Good afternoon, everyone. Respected chief guests, distinguished faculties, esteemed participants, I would like to welcome you to this one-day Bangalore seminar organized by Thiruvananthapuram branch of ICAI. A very warm welcome to all. It's great to be back with the physical seminars with Suri Hall, not fully packed up, but almost. Thank you, God Almighty, for allowing us and all my fellow chartered accountants for your participation. The month of April will be a busy month for CAs and bankers as they have to do a major task which will benefit the banking system and the society at large. With the increasing complexity of the financial system, audit as a public good has become vital for a sound, stable, and vibrant financial system. Auditors need to update and upgrade skills on a constant basis and perform their tasks in the most effective manner. The profile of tomorrow's auditors will be that of a critical yet constructive challenger with a clear focus on public interest and quality audits. As we know, government is going ahead with system-driven processes and the need of the audit at branch levels are questioned, there is need to be even more professional, qualified, impartial, value-driven, ethical, and also display awareness and foresight, which is in fact the need of the hour. With this, let me get on to the job of welcoming the dignitaries. We are pleased to have with us Sri Harishankar S., the Independent Director of Kerala Bank, who has very kindly consented to be as chief guest of this function. We welcome you to the branch, sir. We are fortunate to have very esteemed speakers for our bank audit seminar, CA Dhananjay Gokhale and CA Kuntal Shah as our faculty for the day. Already we had a detailed session from Kuntal Shah, and he has to go in between. And Dhananjay sir is from Mumbai, and both of them are very busy faculties taking sessions across the country. We are very thankful to CA Dhananjay Gokhale and Kuntal Shah for accepting our invitation. We welcome you to this branch. Last but not the least, I extend a warm welcome to all the members gathered here. I hope the seminar will enlighten the steps that needs to be taken in this direction and will be a tool for conducting a comprehensive evaluation of our existing practices within the framework of best practices and what has to be done in this respect in the near future. Thank you all. I invite our Vice Chairman, C.A. Ramakrishnan, to introduce the speakers.
Chairman Dhananjay Samuel, Chief Guest and eminent banker Sri Harishankar, brilliant faculty C.A. Dhananjay J. Gokhale, and our versatile secretary C.A. Nikhil, esteemed my beloved fellow members, pronounce you all. Now I move on to my duty of introducing the chief guest. Sri Harishankar S. After graduation in agricultural science from the College of Agriculture, Ballayadi, Trivandrum, and spending couple of years with Agriculture Department, joined State Bank of Travancore as probationary officer in 1985. In a banking career spanning 36 years, worked in operations, credit, international banking, information technology, inspection, BPR, finance and accounts, compliance and whatnot. He had a stint of 4 years in SBI Canada Toronto branch from 2009 to 2013. Joined SBBJ, State Bank of Bikaner and Jaipur, as Chief General Manager, Retail Banking in 2016. In 2017, joined Ahmedabad Bank as Executive Director. Selected as Managing Director and CEO of Punjab and Sindh Bank in 2018 September. Took voluntary retirement in September 2020. Joined the Board of Directors of Kerala Bank as Independent Professional Director, nominee of Government of Kerala in September 2021. With these few words, I am very glad to introduce our chief guest of the day, Sri Harikumar S. Over to you, sir.
Respected dignitaries on the dais and the esteemed gathering of chartered accountants sitting in front of me. Very good afternoon to you. I think my time that's allotted is 15 minutes. I try to confine my speech within that. Brevity is beauty, isn't it? When I stand before you, there are a couple of things which cross my mind. One is a very age-old quote on communication, and that says, communication is relating perceptions with truth. Relating perceptions with truth. The other one is a quote from a book which I have started using more often of late. So I don't think any one of you would have attended any session handled by me or any speech given by me in the last month or so. If you had, probably you might feel that, say, why this man repeating this? But there is a reason, even if it is a repeat. The book I am quoting this from is Richard Bach's Jonathan Livingston Seagull. Most of you would have read it. It's a beautiful book. It says, it's a story of Jonathan Livingston, the seagull. The book says, Richard Bach says, the Jonathan Livingston telling his fellow seagulls, he says, what he says is, never believe your eyes. All they show is limitation. Look unto your heart. Look with understanding, and that will give you a way to fly. I repeat, never believe your eyes. All they show is limitation. Look unto your heart. Look with understanding, and that will give you a way to fly. So why am I saying these two things? When you look at a set of figures, when you are auditing a company, now the subject matter is a bank, you look at a set of reports, you draw your conclusions out of the reports whether the bank has been compliant in categorization of its assets, in recognition of its income, in carrying out statutory obligations like deduction of tax at source and etc., etc., and whether the assessment of safety in an advance, intrinsic safety in advance, has been biased or judgmental, or has it been objective. So there are areas which you look into based on certain figures. Figures don't speak by themselves, you need to make them speak. So figures are a mode of communication by the bank to tell you what we have done. And in making our implications, or rather our judgment call on what we have made them to be. That communication is a perception of the banker to you. So when you look at that, you need to relate that perception with truth. And what's the set of truth? The set of truth is a set of instructions which the regulator has given, or which the regulators have given. You look at that and you correlate. This is part number one. Part number two. Look at, I have seen it happen with, it's my personal experience. I was actually waiting for a bus in Kottayam bus stand to travel from Kottayam to Kozhikode. That was during my stint in the Department of Agriculture. I was very young, immediately after my college. I used to travel by bus. When I used to come home, after visiting my parents, I used to take the bus. I never used to wait for a particular bus. The destination was Kozhikode. The time to reach Kozhikode was X. So I would start at a time A from here. And my habit was to jump into the bus, whichever had a seat, which was traveling northwards. So in one such dawn, I stopped at my bus terminated its first leg of journey at Kottayam. I was waiting for a bus to take me to Kozhikode. And here was a gentleman who was standing by me. And a bus came. It was a super fast bus to Kozhikode. So the ticket fare at that point of time for super fast bus was a little higher than that of ordinary fast passengers. And I jumped in. I expected the gentleman also to follow. He came, hesitated at the door, and then he asked the conductor, "What's the fare?" So conductor said some amount. He said, "No, I'll wait for the next bus." So conductor to caution him, the next bus is after a couple of hours. There are seats you can come in. He said, "No, seats do not matter to me. What matters to me is the money that I have in my pocket." So he was so conscious about spending that 5 rupees extra. He didn't have enough surplus. The correlation I'm trying to make is the huge capitalization that has happened to public sector banks. I hold the premise that it was necessary, though maybe in this forum itself I may get different views, or rather differing views of what I have just spoken. Public sector banks needed that capital support from the government because of various reasons. This is not the forum to elaborate my set of arguments to that, so I'm not going to that area at all. And with that capitalization of 2 rounds, what has happened? All banks in India have started showing a very healthy CET1 ratio, CRAR. CET1 ratio and CRAR I'm saying separately because we are following the Basel III norms. The point which I am trying to infuse here, though it is not necessarily a part of my inaugural speech here, but I would like to plant this seed of thought to the minds of people with whom I interact. Basel III norms are for banks with international presence. A bank like Punjab and Sind Bank, of which I was managing director and CEO, doesn't have international presence, nor its business analysis and discussions, directors' business analysis and discussions have ever said anything about growing abroad. So it's confined to India as per its foreseeable business plans, which is well elucidated in its annual statements. It doesn't have such a plan. It is a bank that is based in India. It doesn't want to invite foreign exchange risk of that order, including investment in a foreign land by way of capital, to start a subsidiary as per the licensing or start a branch, whichever way the license has been granted as per the norms of that country. So it doesn't want to do that. All it does is limited international banking transaction by way of trade finance. It takes positions in the normal foreign exchange day-to-day transactions, and the derivative it has is mostly only the forward contracts it books, no other complicated derivatives. So the balance sheet of that bank is fairly simple to understand and fairly simple to operate, and the risk is very, very clearly elucidated there. It is not that the bank doesn't have the capability to do any of this. The bank doesn't want to do that because it was in a mode of consolidation, conservation. Now, the question I'm asking is, does this bank have to be governed by the norm of Basel III? Or would this bank be not more comfortable? Would the government of India be not more comfortable? Would the banking community, the auditing community in India would not be more comfortable to have a bank have more resilient capital by way of the Basel II norms, which is Tier 1 and Tier 2 capital together and the CRAR together? So now that's one question. So all those questions, all those things, and again, your PD that you are going to compute. I'll tell you what's your loss given default and what's your probability of default. I worked in Rajasthan. I worked in Jaipur. Headquartered in Jaipur. I know this state very well. I have traveled extensively in that area. It has got Sri Ganganagar, which is almost having a Punjab-like weather conditions, climatic conditions, and it has got just south of that, southwest of that, Bikaner, where it is completely rain-fed agriculture. So all that those farmers, farming community in that state, in that particular district, which is southwest of Sri Ganganagar, they are able to grow birani crops, that is purely rain-fed crops, and that is an annual crop. That will give them yield and cash flow only once in a year. And of course, agriculture categorization norms are very clear, RBS guidelines are very clear. But think of this farmer who has borrowed money to construct a house, to buy a car for his commute, buy a scooter for his commute. There the norms are different. He has to meet up with his installment and interest in 90 days norms. Otherwise, a man whose cash flows are only once in a year has to meet up with the payment obligation, which is 90 days, tri-monthly. There is a dichotomy. I was executive director of Allahabad Bank. I found during one of the quarterly analysis that huge loans, home loans given to professors of a university were in almost in an SMA2 category. I said it's impossible. I pulled up the zonal manager, asked the branch manager to give me an explanation as to why that has happened. A regular salaried person, a professor in a university, slipping his asset into SMA2 because he has not met up his payment. So then they came back with, sir, it is not that. The university pays them once in 4 months. The cash flow of the university is once in 4 months. So here the norms are something else, the cash flows is something else. Okay, you forget that, that's an extreme case. But think about this farmer, his home loan, you are cutting, and your probability of default, your LGD, everything is based on this norm. And when you discuss India's format, you have all these kind of dichotomous situations coming in. I asked consultants who came to discuss this with me, 2 banks, as to why you do not have granularity prescribed for these kind of things. He said, we'll take up with RBI. And I think that happened in 2016, it had happened in 2017, it happened in 2018. I don't think RBI has come up with any concrete decision on this. So this is a dichotomous thing that I'm speaking of when you are looking at a set of reports. So to come back to the quote which I said on Richard Bach, from Richard Bach's book, look with understanding. Now that looking with understanding is slightly simple now. Now before I explain, I go on to that. I got 5 more minutes. Before I go on to that, let me just say, I started with capitalization. So now, look at the story of this man who didn't have that 5 rupee extra, for which he postponed and he's traveled by another 2 hours to get a bus according to his money that is available, not a super fast. Indian banking system was going through something like they had to conserve every penny of capital they had to see that they did not default in the draconian CET ratio and draconian and other norms, though their presence is only in India. So international presence, those banks which did not even have, they also were governed by the same kind of guidelines and they had to conserve this capital. So they were very conscious about, they would go any end, fighting to see whether an actual fraud has happened. All kinds of forensic auditing or transaction audit, you prescribe everything and they will go through everything to see that finally, oh God, this is a fraud. They will recognize only then. That is because they didn't have the money. So the forbearance of the foresightedness, which we always profess, you need to recognize everything in advance, so that you are not in for any state of surprise. That is good for a house that has money. It is not good for my fellow traveler who had to skip his bus from a super fast to an ordinary fast because he simply didn't have enough money to pay. Now with capital coming in, with PCRs in the range of around 80 to 88%, that is the average PCR in Indian banks in India, you have got enough cushion, you are well provided for. You are more confident in taking such judgment calls. The bankers are now looking with understanding. What is a good asset? What is an intrinsically strong asset? What is an intrinsically weak asset? Because they have the luxury of that money to recognize in advance and then do accordingly. Now, with that, I think the task of relating perceptions with truth becomes simpler, easier, and they are more upfront. Now, there is another thing that has happened. All the forbearances provided by RBI in categorizing, in restructuring of advances, they are all in the waning. In the balance sheets of restructured standard assets, that category is almost now diminishing. You can see that in any bank, I think that category is no more there. In many of the banks, I think that category of restricted assets, that is actually in the way out. Either they have all gone to NCLT for recovery, resolution, or even liquidation, or they have become standard by their own means. So that period was one where auditors always used to express doubts about the recognition of whether it is standard or not. In the standard restructured assets, much was there for interpretation. So that's where we used to take a call. We used to sit with auditors to see why we have, and auditors say, and I would say, why you should not. So that arguments always, it's all very healthy kind of exchange of ideas. Finally, we would come, okay, this we accept your position, this we can't accept your position, then finally you set where the balance sheet and go. So now, that period is also, that time is also over. Now things are becoming fairly simple, straight. There is money, there is enough money for people to take the judgment call. Okay, if I am not well today, I will walk into the clinic and have my body examined. If the doctor so says that, okay, how much is my purse? Do you get an insurance cover? Are you covered by some scheme? I will say yes, and he will put me to the CT scan. So that everything is, I will do that. But I wouldn't do that. I wouldn't even dare to do that. I would postpone because I am the breadwinner of the family. If I get hospitalized, my entire family suffers. I had that constraint for my purse strings, so I would not do that. I will say nothing. I said, "ठीक है, कुछ नहीं, सब कुछ ठीक है. ये कहने का है." I mean, just a matter of thinking. This is a matter of thought. I mean, so the breadwinner of the family would go on doing. That happens in life, isn't it? So looking with understanding means all these kind of things. So whether you are judgmental, you are objective, and that is one part. The second part, which is equally important, is how we approach the LFAR. LFAR, I would say as a banker, is the tool for a banker to really understand the direction in which its assets are going, its conduct is going, and if any banker has an open eye, an open mind to discuss with you, the auditor, the parameters on which you have concerns, where you have mentioned certain areas of concern, there if you are paying attention, that saves the bank. I have had the fortune of being with extremely good auditors, very understanding people, and people who would say, no, this we will not accept, this is my backstopper. Here you have an area, I am prepared to accept this. So that healthy exchange of ideas always used to help me. I have handled audit committees many number of years in my life. I have been a part of at least 5 boards. So I know how it happens. I have headed sections where I used to be the interlocutor between the auditors and the bank's other departments. So LFAR. But in my LFAR experience, all the things are all which the banker should take care of. But one thing which I always request auditors to take care of, which I had occasions to tell auditors also, is that don't ever give judgmental comments there. If you write that this asset for these reasons are causing concern, that's fine. But if you make a statement that this asset is certainly a bad one, you may get surprised, but I have seen such reports. I had to tackle such reports also. So never be judgmental in your LFAR comments. Without being judgmental, being thoroughly objective, you will be able to tell your points. The banker will understand your points and he will comply. And it's the utmost responsibility of the banker to stay compliant, so that ultimately we are trying to create an institution, run an institution which should not get its names changed or ownership changed because of certain dastardly acts of misses in the corporate governance areas. So that the banker should understand. The banker understands because he is accountable. He is accountable to the government. He's in the public sector. He's accountable to the shareholder. The best shareholder, the most prominent shareholder is the government of India in most of the banks, and it is to the other retail investors in that bank. He is, and he understands that. The board also understands that. So I think he will stay compliant. So LFAR is another tool where we can work to improve the banking system in this country, make in a very practical way. I think that covers whatever I had to speak with you. I think my time also, I'm not overstepping with these words. Let me say that, say inauguration at this time looks a little odd to me, but should I say it's, okay, this is an inaugural session, so I declare this meeting inaugurated. Wishing very happy production and thanks to the banks in the next financial year. Do your best. Bankers need you, and you also need bankers, because it's a very mutually beneficial relationship that we are having in the industry. Good day to you. Thank you.
Respected Chairman, our Chief Guest, Sri Harishankar, faculty for the second session, Sri C.A. Dhananjay Gokhale, our Vice Chairman H. Ramakrishnan, and my dear professional colleagues. Good afternoon to you all. It gives me immense pleasure to propose vote of thanks for this inaugural event. A special thanks to our Honorable Chief Guest, Sri Harishankar, who, despite his busy schedule, has found time to grace this occasion. Your thoughts has truly inspired us, sir. I request our chairman, C.A. Chiriyanji Samuel, to present a memento as a mark of our gratitude. I would also like to thank each and every one of you being here and making this event a grand success. Thank you. The food is being served in the second floor of the canopy. Request all of you to have lunch and reassemble by 1:30. Thank you all.
We will move to the second session. I invite our treasurer, Sri Vidya, to introduce the faculty.
I am very glad to introduce before you CA Dhananjay Gokhale, the faculty for our next topic, Overview of IRAC Notes. He is a Bachelor of Commerce from University of Mumbai. He is a fellow member of the Institute of Chartered Accountants of India and is in practice for more than 20 years. He is the founder partner of Dhananjay Gokhale & Co. Chartered Accountants, Mumbai. He has vast experience in bank audits and IS audits of banks. He has handled audits of various public sector, private sector, urban and multi-state cooperative banks in different capacities. He has been a speaker at bank branch audit seminars, certificate course on concurrent audit of banks, certificate course on cooperatives at various branches, and study circles of all regional councils of ICAI, and staff training seminars organized by banks. He has been a member of the expert panel constituted by the Auditing and Assurance Standard Board and the Committee on Information Technology for addressing the queries of members relating to bank audits for the financial years 2011-12, 14-15. He has authored articles in reference material published by WIRC on statutory bank audit in financial year 2011-12 and 12-13. With this, I introduce before you CA Dhananjay Gokhale. Over to you, sir.
Thanks to all of you to be here for today's bank audit seminar, and thanks once again to the management committee of Thiruvananthapuram branch, and thanks for the introduction which was given about me. Today we'll be talking about IRAC norms, that is Prudential Norms on Income Recognition and Asset Classification and Provisioning Norms. Even though this topic is a kind of routine topic, I should say, which is always there at every bank branch audit seminar. So it's more of kind of a refresher kind of a thing for all of you in most of the circumstances. Nothing has really changed as compared to the last year, except couple of changes which RBI has brought in by way of 12th November circular and 15th February circular. And there is a master circular which has got issued in the current year, that is October 21 master circular, which is relevant as of now. Before I start off with the audit, let me just reiterate my past memories with uh, the city of Thiruvananthapuram. We were central auditors for SPT, so I had been here almost at too much of frequent intervals. Actually, we were here as a SPT central auditor from 2000 to 2004. So those fond memories are still with me, and it's a pleasure to again revisit to Trivandrum. Somehow I was able to visit Trivandrum only once, in between the long span of almost 2 decades in between. And a few things are little different in Thiruvananthapuram because Malayalam is the language wherein Ada is used as it is used in Marathi, which typically is not used across India. So many times it used to happen that the pronunciation which in Malayalam is made, we were able to make it out actually. For example, the Z is pronounced as a, that is something which was difficult for other auditors, so we were having a kind of advantageous position. I just thought that I will just reiterate those memories with you. And in Mumbai, actually, we have a variety of languages which are spoken, so we get used to that. So again, coming back to the topic, I just thought of mentioning with all of you because usually, there are whenever a central audit is done, actually, the city where the head office of the bank is there. Central auditors typically keep on kind of a developing of affection or fondness for that city. Similarly, I have a similar scenario with Hyderabad also because we are central auditors for SPH. And usually, if it is not a metro city, the things are much simpler actually as compared to the metro cities wherein time is essential as compared to personal relationship, which typically doesn't happen. Okay, now coming back to the topic, we have almost a time of maybe 2 hours or something more than that, so we can elaborately discuss about NPA provisioning norms, and we can have an interactiveness between the session also. So if you have any queries in between, you can interrupt me in between also, and you can ask me any queries. And if you have different views also, you can express. I will try to give maximum practical examples as possible rather than sticking to the theory so that it becomes more interesting. Typically, in post-lunch, that is something which is really required for both actually audience as well as the speaker, that I should understand that what I'm speaking and you should understand what I'm speaking. So it's a mutual thing. Now this is what I intend to cover throughout the session. Few things which are there in the slide, which I will just touch upon is that because those are not directly relevant, I will first tell you which are the things which I will just make a passing reference of. First is the COVID circular which was issued on 6th August 2020. So that is a resolution plan 1.0, and in the current year resolution plan 2.0 is there. So we'll just make a comparison between these two plans because I'm sure that most of you are already well versed with that earlier plan. The slides are written purposefully that so that the presentation material when it gets circulated to you, you can use it as a handy material. But we will not again spend time to again reiterate what was there in the last year. That is one. Second is resolution plan which was issued in June 2019 circular that has been now incorporated in October 21 master circular. I'll just touch upon that plan. The reason being that is applicable only for advances which are more than 1,500 crores. So practically that doesn't apply in most of the branches. So we don't have to really get into nitty-gritties of that, but I will just highlight that what are the major things which you need to keep in mind. Again, the detailed presentation is already there. So if you happen to do a bigger branch, maybe a CFP, IFP or overseas branch wherein you come across such kind of exposure, you can always refer to that particular point. Otherwise, we'll cover each and everything which is there in the circular. Even I will go a step beyond if time permits. That there is a master direction which has got issued about transfer of loans. So wherever the NPAs are sold to ARCs, there is a new master direction which has got issued. There are a couple of interesting points are there which I will just like to touch upon if time permits. Not that every one of us will be doing audit of sale of NPAs to ARC, but there are certain points which are vital from accounting perspective. So as a CA, I thought that I should share that particular part, which can be a kind of a general knowledge about other activities which are taking place in banking area. Now, firstly, let's just have a glance at which are the circulars which have got issued, and these are the circulars which typically should be available handy with you whenever you are doing audit. Besides, of course, bank audit guidance note. which is already published in the month of January itself. So the cutoff date of that publishing has been already specified in the guidance note. So whichever circulars are getting issued subsequent to that, just keep a track of those circulars. If any major circular gets issued, typically institute issues an advisory or a supplementary related to that guidance note. But otherwise, if a circular like say 15 February circular is issued, it's more of clarificatory in nature, and you may not find any supplementary for that guidance note. So first circular issued is October 21 master circular, and this master circular has got issued after almost a gap of more than 6 years, because the last master circular was July 15. So we are having this circular which is comprising of all the circulars which are got issued during the period of July 15 till 30th September 2021. So it's a compilation of circular. It contains each and every circular, so you don't have to again go back to referring the circular prior to October 21. After this circular got issued, there is a clarificatory circular which has got issued on 12th November 2021. One more clarificatory circular got issued on 15th February 2022. As far as this 12th November circular is concerned, besides being clarificatory in nature, there are certain conditions of IRAC norms which have got changed to this 12th November circular. I don't know really the reason why RBI issued a circular in a span of 1.5 months after issuing the master circular and changing certain parameters. But anyway, those parameters have got changed. So we'll touch upon those parameters also. Then as far as June 19 circular, as I said, which was for a prudential framework for resolution of stress assets, that is now incorporated in October 21 circular. But I will suggest that if you come across an account which is wherein the RP has been implemented, refer to June 19 circular because it is more elaborative in nature. October 21 is circular has para 9, which is in a concise form. It doesn't give preamble and commentary related to the resolution plan. So you can always have that circular also handy with you. Then as far as MSME relief measures are concerned, there are series of circulars which RBI had issued. Two circulars are applicable for the current year. One is 6 August 2020, which might get applicable to certain accounts which are wherein the resolution plan under MSME relief has got implemented in the initial days of the current financial year. And subsequently, we have 5th May 2021 circular, wherein the plan is again extended with a cutoff date of 30th September 2021. So that will be the second relevant circular for the current financial year 21-20. This is these are all circulars are related to earlier year, that is 2021 financial year. So I just made a list of that. That these are the COVID-19 related RBI circulars which have got issued. We might need to keep on referring to 6 August 2020 circular for the simple reason that there might be certain financial parameters which are defined in September 2020 circular, which are yet to be complied or yet to be achieved by that particular borrower. So you need to keep a tab on August 20 circular and September 20 circular along with the New Year's, that is 21-22 circulars. Then in the current year, we have circulars which have got issued on May 2021, which is a resolution plan 2.0, which is a kind of extension to earlier resolution plan of August 2020. Then another circular which has got issued is in June 2021, wherein the exposure cap on MSME loan has been increased from 25 crores to 50 crores. So that is one major change which has occurred in the current financial year. Then 7 July 2021 circular is very vital because the MSME definition has now been expanded to include even the retailers and wholesalers. So earlier circular, that is prior to this July 21 circular, the retailers and wholesalers, that is the retail trade business and wholesale trade business, were not included in the definition of MSME, but now everyone is practically getting covered. Then we have 6 August 2021 circular, which talks about extension of time which is given to achieve the financial parameters which were defined in September 2020 circular. So the financial parameters which are supposed to be achieved by those accounts which have been undergoing resolution plan under earlier circular, the timeline has been extended now to March 2022. So there is an extension which has been granted through this August 21 circular. So now let's come back to the topic. So this was earlier was just a summary so that you can keep all those circulars handy with you. So as far as IRAC norms are concerned, there are certain opening paragraphs wherein RBI has defined or RBI has specified that what it really expects from the bankers and as well as from the auditors. When I'm saying auditors, I'm categorically saying from auditors, the reason is that as far as provisioning norms are concerned, those are required to be complied by bankers as well as auditors. So the primary responsibility of correct provisioning is there not only on the bankers, but it is also on the auditor. Typically, what we always presume is that the management is primarily responsible for each and everything, and we are only there to verify that. But that is not the case with IRAC norms. The provisioning is our primary responsibility also. So pay a little more attention as far as IRAC norms as well as provisioning norms are concerned from auditor's perspective. So what RBI expects is RBI expects that the bank should classify the accounts on a very in a very objective criteria, with a very objective criterion. There is no scope for any subjectivity which is expected as far as RBI's norms are concerned. So whenever the banker says that there is a subjectivity about IRAC norms, there is certain you can say extra normal power which is available with the auditor to decide whether account is PA or NPA. There is nothing like that. NPA norms are theoretical in nature. So whatever is prescribed by RBI in the IRAC norms, as an auditor we need to comply with that. Just to give a passing reference, actually, today's chief guest, what he was referring to was a correct statement that we don't have a concept of matching of income source or periodicity of income as far as the repayment schedules are concerned. There is another side to this rule also. So as far as the credit portfolio, credit sanctioning part is concerned, that is left to the discretion of the bankers. It is not in the hands of the auditor. We cannot question the credit function of the bank. No one has stopped the bank to balloon the repayment schedules. The only issue is that the bankers don't match income source periodicity with the repayment schedules. As an auditor, we can't do anything actually. Whatever the bank has sanctioned, we have to go, go by the terms of sanction. Whatever is the repayment schedule prescribed by the bank, that's what we need to refer to. Why that the repayment schedule is prescribed, that is not our prerogative. We cannot question the bank also. So even if we are aware that the person who has availed the loan is agriculturist, he is having income which is received once in a year, practically as an auditor we can't do anything. So only thing is that we can only express our you can say affirmation about these things. It is in the hands of the bankers ultimately. Let me just add one more point. RBI nowhere in the circular specifies about what should be the periodicity of repayment. It only talks about how the interest should be calculated. It doesn't even talk about how the interest should be paid. So just to give a hypothetical example, if a bank decides to carve out a particular product which has a periodicity of repayment of principal and interest once in a year, that is very much permitted as per RBI norms. There are no norms which are prohibiting that. So interest can keep on getting debited in the account, but it may not become due immediately. It is a concept of accrued but not due, and it can become due based on whatever is the repayment schedule which is prescribed by the bank. So we need to go by the repayment schedule prescribed, irrespective of whatever is the appraisal process or whatever it is there. That is bank's domain. We can only verify whether the appraisal process is done by the bank in line with the credit policy of the bank and whether it is in compliant with RBI policies or not. And we cannot go really beyond that. So when we are talking about classification norms, those are objective in nature, which are supposed to be followed by the banks. Second and very important thing is that the bank is supposed to carry out the classification of advances criteria in a uniform and consistent manner. They cannot distinguish between two borrowers on any count except for the conditions which are specified. So irrespective of borrower's reputation, irrespective of the borrower's credit rating, irrespective of the security cover which is available, the norms are same. So if a borrower is maybe a reputed borrower, maybe a Tata Group company or a Reliance Group company or a Birla Group company, and a normal layman actually is drawing a salary of 5,000 rupees, the IRAC norms are same. So there is no distinction which is made between two borrowers in any form. Now when we talk about provisioning, there are a couple of things which we need to keep in mind. First one is that what is the classification of advance? And if the classification is standard, only the prudential provision is required, which is a minuscule level, because it is only a kind of a prudential thing, which is wherein we are not even envisaging that there is a realization risk which is really involved. So it's only a you can say notional kind of a provision. If the classification is NPA, then the second thing which we need to verify is for how long the account is classified as NPA, because that is the basis on which we will decide whether it is substandard, whether it is DA1, DA2, DA3, or maybe a loss asset. Then once we decide that what is the classification of advance within NPA category, next part is that we need to verify whether any security is available against that particular borrower account. The security can be in the form of primary security or it can be form of collateral security. The limitation of primary security is confined only to the extent of calculation of drawing power or drawable amount. But as far as security cover is concerned, we need to factor in both primary as well as collateral security. Now, when we have the security cover available, then the last thing which we need to verify is that whether it is realizable and what is the realizable value of that. So here we need to be very critical about considering the value which is a realizable value, or at times we might have to stick to the distress value which is specified in the valuation report. Fair value which is specified in the valuation report is something which we don't even have to factor in whenever we are calculating provisioning norms for NPS. We need to go by either distress sale valuation, or we need to go by realization method, wherein the valuation report will specify this value. Now, broadly, assets are categorized into two types. One is standard asset or performing asset. Second one is NPA, that is non-performing asset. The simplest definition of performing asset can be any asset which is not a NPA, we can call it as a standard asset. But the more scientific definition is that standard assets are those assets which are not carrying risk which is more than normal banking risk. As compared to that, NPAs are those which are carrying risk which is more than normal banking risk. So let me just elaborate this concept. See, what is really mean by normal banking risk is, as all of you are aware, the banks are into business of lending. So whenever anyone is in the business of lending, there is an inherent risk of realization which is involved. Whenever you lend money to any person, irrespective of how close that person is or what kind of security is given by that person to you, risk of realization will always be there for any lending function. Now, as far as that inherent risk is concerned, that is called as normal banking risk. So that will apply to each and every account or each and every asset. But in case if there is a risk which is more than normal banking risk, no more than inherent risk, then that account will be classified as NPA. So let me just give a couple of examples of that. As all of you are aware, the normal NPA norms are related to 90 days delinquencies, which are categorically specified by RBI. So there you don't have to really apply this particular logic that whether inherent risk involved or not, that is not relevant because the norms are very specific. Now there are norms actually which categorically specify as to what is meant by more than normal banking risk. So let me just give you a couple of categories related to that. Let's presume that a bank has sanctioned a project loan, and as you are aware, whenever the project loan is sanctioned, the bank has to also predefine that what is the date of commercial operation, that is DCCO. What is meant by DCCO is that is the date by which the commercial operation or commercial activities in that particular account are expected to start off. Now, if the DCCO is not extended and if the commercial activities do not start by that DCCO, which is predefined by the bank, then the account will turn into an NP account. The reason being, there is now an additional risk which is involved because the commercial production hasn't started. So it might happen that that particular borrower account or that particular factory, if we have lent to the factory premises, the factory may not even enter into a commercial production altogether. So till the time commercial operations do not start, the account will turn into NPA. Even if otherwise the account is normal, even if there are no overdues in the account, still we have to mark that account as NPA because there is an additional risk which is involved. Let me give second, another example. Let's presume that we are having a loan which is sanctioned against a primary security of immovable property, and in the last year the immovable property was valued at say 10 crore, and as per the bank's internal policy, the security valuation has been again carried out in the current year. Now, when the new valuation is received to you, you notice that as per the new valuation, there is a deterioration beyond 50% of the valuation which was done earlier. So, suppose earlier valuation was say 10 crore, and today's valuation is say 4.80 crores. It means that there is a deterioration of 52%, which is beyond 50%. So, wherever there is a deterioration of valuation beyond 50% as compared to the earlier valuation, then you don't have to wait for that 90 days delinquencies now. You have to straight away classify that account under doubtful asset category. Let me give you a third example. Let's presume that you are having a secured loan and the security available against that particular secured loan is less than 10% of your ledger outstanding balance. In that case, you have to straight away take it to loss asset category without waiting for 90 days delinquencies. Let me tell you a fourth example, that there might be a possibility that you have noticed that a particular account operations are not really properly carried out, and as an auditor you have the opinion that there is an inherent weakness in the account. So wherever you foresee or wherever you conclude that there is an inherent weakness in the account, you don't have to wait for 90 days period and you can straight away classify that account as NPA. But this fourth example which I am giving, that has to be diligently used by you as an auditor. You cannot just pick up an account randomly and say that there is an inherent weakness. You need to prove that point also beyond doubt based on maybe account operation or based on the nature of transactions which are carried out in the account, and then only you have to conclude. So these are just few examples which I thought that I will just give it to you, which are going beyond 90 days normal norms. So in next couple of slides, we'll talk about the basic norms of NPA which RBI has defined. So to begin with, we will start off first with term loan accounts. So in case of term loans, if any interest, installment or EMI, if it remains overdue for a period of more than 90 days, then the account will turn into NPA. Now here the word overdue is very important. The reason being, unless and until a term loan account is overdue, that account cannot be really classified as NPA. So let me just give you one example about a little different scenario. So let's presume that we are having a housing loan, and the housing loan borrower is prepaying the installment, maybe say 12 installments in the month of April itself, and subsequently he hasn't paid any installment altogether for the remaining duration of the particular financial year. So if you look at the ledger account, it will appear that in the month of April there is a lump sum amount which has got deposited. Subsequently, all 12 interest entries will be there for every monthly interest. At the end of the year, that is in March, there are certain mistakes which are done by the auditors and also by the bankers to mark such accounts as NPA under the pretext that the interest is not serviced. I will just like to put one point over here. Interest servicing is not a concept across NPA norms. What is very important is that as far as term loans are concerned, whether the account is overdue or not. Now, how to calculate the overdue component? Typically, in most of the CBS systems, there is an ideal DP calendar which is available, which is nothing but repayment charge. So you have ideal DP as on a cutoff date, which is always available through CBS systems. You have to compare your ledger balance with ideal DP. If your ledger balance is more than ideal DP, the differential is your overdue. Wherever your ledger balance is below ideal DP, the account is not overdue, and that account can never be classified as NPA as far as term loans are concerned. Interest servicing concept will be factored in only after the account is marked as NPA. So when you mark an account as NPA, then whatever is the unserviced interest component which is lying in the account, that has to be reversed or that has to be provided for. So keep this thing in mind, that don't classify any account just because interest is not serviced. That is not the criteria itself. The criteria is about altogether different things. Now there is a para 2.1.3, wherein there is a concessionary treatment which is made available to the term loan account holders only in certain specific circumstances. Now these are the accounts wherein there is no component of principal which is repayable in a particular period. So usually, a bank might be sanctioning a loan wherein say initial 6 months there is a moratorium period for principal repayment is granted, but interest has to be paid on as and when basis. So in such cases only this para 2.1.3 will be instrumental. Now what kind of leverage this para gives to the borrower is, this para says that if any interest which is debited in a particular quarter, if it is not paid or if it remains overdue beyond next 90 days, then only the account will get marked as NPA. So let me just give you a practical example. Suppose we are considering a quarter of say October to December, and there is no principal repayment, so there is a moratorium for a principal repayment. So October, November and December interest, if it is not paid by next 90 days, that is by March 2022, then only the account will turn into NPA. So this is a kind of a leverage given for say October and November interest payments, because for October you are getting 5 months, for November you are getting 4 months. So that's a kind of a concessionary treatment which is provided in the circular. This concession has been now removed through 12th November 2021 circular, wherein it is specified that this concessionary treatment will not be applicable from 31st March 2022 onwards. So till 30th March 2022, the same treatment continues. But going onwards, now this concession is not available. So from 31st March 2022, we need to calculate 90 days from the date of due date of that particular interest portion also. So no concessions are really extended. Concession has been removed now. A couple of exceptions are there to this rule of overdue concept. In certain cases, it might happen that the bank has given moratorium period for for payment of interest as well as principal component. So in such cases, interest will keep on getting debited in that particular account, but the interest is not considered as due. And if the interest is not due, there is no question of amount being considered as overdue, so the account will remain into standard asset category. So in certain cases, bank might have a product where in say first 6 months you don't have to pay interest also and you don't have to pay principal also. But naturally the interest will get debited in the account because that is mandated by RBI. But it doesn't become due unless and until 6 months the period gets over. So the 90 days counting will be only from the date when the interest is due and not prior to that. Second example or exception is that in many banks they are having staff loan schemes which are having a different kind of a repayment schedule. Typically they have a repayment schedule wherein first principal portion is repaid and followed by interest portion. So you have to go by that repayment schedule. and not strictly by principal, interest or EMI concept. So you have to go by whatever schedule is prescribed. So if as per the schedule, last 90 days amounts which were due are not paid by that particular staff, then only the account will get marked as NPA. Then in case of bills purchased and bill discounting facilities, if it remains overdue for a period of more than 90 days, then the account will get marked as NPA. Then as far as agricultural advances are concerned, in case of agriculture advances, if your interest or installment, if it remains overdue for a period of more than 2 crop seasons with respect to short duration crop, and if it remains overdue for more than 1 crop season with respect to long duration crop, then the account will be marked as NPA. Now here we need to touch upon a couple of definitions which are given in the circular. First is the definition of crop season. Second is what is meant by long duration crop. Long duration crop, the definition is that wherever the crop season is more than 12 months, then that will be considered as long duration crop. Now, who decides this duration of crop is? For every state there is a SLBC, that is state level banking committee, and the SLBC defines that what is the expected crop season for that particular state for each and every crop which is taken in that particular state. So wherever you are doing audit, you need to refer to the minutes of that SLBC of that state, and you have to be governed by that. Now I'll tell you where the challenges are, and I will touch upon some other aspects also. I'm sure that many of you are aware that in the last year RBI had issued a guideline somewhere in September 2020, wherein they mandated the banks that the IRAC process should be automated with effect from 30th June 2021. What it really means is, it means that income recognition, asset classification and provisioning, everything should be automated. No manual intervention is expected. All the banks have confirmed that they are compliant with that. I'm having serious doubts about that for the simple reason that agriculture advances related data is never captured in CBS system. I will tell you a simple example. So let's presume that we are having an agriculture loan. So if you want to really have automation in IRAC norms to be implemented for agriculture loan, you need to have master data consisting of crop seasons related to all the crops. Then you need to have annual data updated in the system, wherein you need to go back to your borrower and you need to ask the borrower that which crop he is intending to take in the current year, because unless and until you know that, you cannot define that what is the crop season applicable for that particular loan. It might happen again that there might be different permutation combinations which are possible. For example, typically in short duration crop across India there are two seasons are there, Kharif and Rabi. But it might happen that a farmer will say that I am taking only one crop. It is short duration crop, but I take that only once in a year. I don't take it twice in a year. Maybe because the life or the crop season is maybe of say 8 months, or the other thing is that he doesn't want to take 2 crops. That is very much possible. So in that case, application of these norms becomes little tricky as to how to identify that which crop season is applicable to which borrower account. Another thing is that the crop seasons do change from year to year depending upon what SLBC concludes. So we need to be little vigilant about what are the crop seasons or crop cycles which are defined by SLBC for that particular state. For the same crop, there might be multiple seasons across the states. Just to give an example, sugarcane is a crop wherein in couple of states it is little less than 12 months. In some states it is 15 months. In some states it is 16 months. So you have to go on based on the state level banking committee's decisions. I just deviated from this part for the simple reason, just to make you understand that nothing is automated in banks, even though they are claiming. If you really want to rely on their systems, think twice, because unless and until you are having basic master data, the system is not able to really do any automation within themselves. As far as the relief measures are concerned, RBI had issued a circular in October 2018, wherein if a borrower is affected by national calamity, the bankers were permitted to extend relief for those borrower accounts, wherein reschedulement, refacement, or financing of giving additional finance to the farmers was permitted. Now, whenever the relief measure is implemented, or whenever the relief measures are given by the bank to the borrower, first thing which you need to confirm is that wherever such relief measures are extended, whether that loan is within the ambit of definition of farm credit or not. So you need to refer to the farm credit definition. If it is fulfilling the definition of farm credit, then only the question of relief measures will arise. Again, to reiterate the point, whether a particular loan is farm credit or not, it will depend upon what is the end use of that particular loan. So just to give an example, there might be a case that a farmer might have applied for a loan for purchase of tractor. The same farmer can apply for a loan to purchase Mercedes-Benz car. Now, a loan of Mercedes-Benz cannot be categorized as agricultural loan or farm credit. Even if the source of income is annual, even if the borrower is a farmer, it doesn't mean that each and every loan which is taken by the farmer is to be considered as farm credit. So we need to first check that whether a particular loan wherein the relief measures are extended, whether it is coming under the ambit of farm credit or not, and then only the relief measures will be applicable. As far as the relief measures are concerned, one more precondition is that in that particular area where the borrower is having his farm credit availed, whether it is affected by natural calamity or not, and there are 12 natural calamities which are defined in the circular. Of course, the declaration of natural calamity is a subject matter of state and center, so they need to declare a particular area as affected by natural calamity. Just to give an inference from that 12 types of natural calamity, COVID-19 was not considered as natural calamity. It was not within the ambit of these 12 defined natural calamities. That's why in all COVID relief circulars, you will find a specific mention about excluding agriculture advances from the ambit of COVID-19 relief measures, because those are required to be covered only under this October 18 circular. Agriculture advances are not supposed to be covered under August 20 COVID-19 relief measures. Now, in agriculture loan, the relief measures are given in related to two types of loan. One is short-term loan and another one is long-term loan. And for both, the eligibility criteria are different. Now, whenever throughout the presentation, whenever I am saying that a particular reschedulement or restructuring is permitted, what I mean to say is, permitted means it is a conditional permission, that if the conditions are fulfilled, you can retain the class of asset. If the conditions are tweaked or not fulfilled or breached in any form, then restructuring is very much permitted, but then downgrading of asset will happen. So just keep that thing in mind. So when I am saying that, say for crop loss of 33 to 50%, you can give an extension of 2 years, it doesn't mean that the banks cannot give extension for 4 years. It is very much permitted. But if that is done, then the account will get downgraded. If you are within the conditions which are specified, you can retain the class of asset under standard asset category itself. As far as short-term agriculture loans are concerned, first eligibility condition is that on the date of happening of natural calamity, the account shouldn't be overdue. So the account has to be within limit as of that date. So if the account is above the limit, even if a single rupee is overdue, it means that if the account is restructured, the account will get downgraded. So this is the first condition. Second is about the crop loss. So if the crop loss is below 33%, and if you do a restructuring, it will get downgraded. But if the crop loss is between 33 and 50%, an extension of 2 years is permitted. And if the crop loss is beyond 50%, an extension of 5 years is permitted. These 2 and 5 years will include a mandatory moratorium period of at least 1 year. And additional facility, if a bank wants to extend to this short-term loan availers, even that is possible to be extended without downgrading of that particular asset. Then as far as long-term agricultural loans are concerned, again they are divided into two types or two events, I should say. First event is that this is the event wherein only crop is affected. That is the crop which is taken for a particular year is getting affected. So in that case, it will get extended by way of extending any amounts, any portion of amount, whether it is interest or principal, by a period of 1 year. So whenever one gets hit by a natural calamity, there is no repayment which is expected for 1 year. Whenever only crops are damaged. Whenever the productive asset is damaged, maybe an electrical pump which is used for irrigation, or maybe tractor is getting damaged, or maybe some goods carrier which is used to, which is used for transportation of agriculture produce is damaged. Whether it is damaged partially or fully, then there is an extension period of 5 years which can be granted. Now here, as far as the moratorium period is concerned, the bank has to decide as to how to give moratorium period in case of second case, wherein you are permitted to go to the extent of 5 years. Now in both the cases, there are a couple of things which the RBI has added. That in many cases, the farmer or the borrower might be getting insurance proceeds, against the crop insurance which he might have taken, or maybe an insurance for say tractor or electrical pump which he has taken. So wherever the insurance proceeds are received, those insurance proceeds should be firstly adjusted against the restructured loan, and then if anything or any surplus portion is left out, that can be adjusted against the current dues. So wherever you come across a case where the relief measures are extended, additional finance is given, just verify that wherever the insurance proceeds are received, where those insurance proceeds are getting adjusted. Because bankers will be always tempted to adjust that against current dues, so that there is no overdue position. So, that's a natural temptation which might happen. So, inquire that how many accounts are under relief measure, and against that, in how many cases you have received the insurance. So that, you can just have it tested to understand that how the bank is behaving in this regard. Then, as far as derivative transactions are concerned, if the receivable position in a derivative transaction, if it remains overdue beyond 90 days period, then the account will get marked as NPA. Typically, you will find derivative transactions only in IFB, CFB, or commercial branches, or typically in overseas branches. Usually, these are the transactions wherein bank offers to its customers various derivative products such as say interest swaps or maybe currency swap transaction might be there. So in that case, if it remains overdue for a period of beyond 90 days, the account will get marked as NPA. Similarly, any liquidity facility which is availed by the borrower, if it remains overdue for a period of more than 90 days, then the account will get marked as NPA. As far as credit card dues are concerned, there is a differential treatment which is prescribed. So in case of credit card statement, I'm sure that all of you must have observed that in the credit card statement, there is a due date and there is a minimum amount due which is specified, which is not an entire amount of credit card dues, which is typically in the range of 8% to 15%, depending upon the credit card issuing agency. So in case of credit card dues, if that minimum amount due, if it is not paid within 90 days from the due date of that credit card statement, then only the account will turn into NPA. Now there is one more thing which RBI has prescribed in the IRAC norms, not directly related to IRAC norms, but related to credit card, penalty impositions. What RBI stipulated is, if a credit card holder pays the dues within 3 days from the due date which is specified, then that default, because he has defaulted, he has paid the amount after the due date. But if he pays that within 3 days, then the default is not supposed to be reported to the credit information agency. So that is one thing. Secondly, as far as penal charges and interest charges are concerned, those are not supposed to be levied to those account holders or those credit card holders who are paying that within 3 days. So 3 days is a kind of a grace period. But when you are counting these 90 days, 3 days grace period should not be counted. It is directly from the due date and not on T plus 3 plus 90 days basis. It will be from T plus 90 basis. Then the last variety of loans is CCOD accounts. CCOD accounts will get marked as NPA wherever the account is out of order. There are 3 conditions of out of order status. First condition is a simple condition to understand. Wherever a CCOD account is continuously overdrawn beyond 90 days, then the account will get marked as NPA. Now here, when I'm saying that continuously overdrawn, what I mean to say is, you need to first calculate limit or DP, whichever is lower, as one factor. You have to compare that with end of the day balance in the ledger account. If the end of the day ledger balance is continuously more than this first factor, then the account will be considered as continuously overdrawn. If it crosses 90 days barrier, you need to mark that account as NPA. Second and third conditions are little different. So these are the instances wherein the account may not be overdrawn, but there might be an instance wherein in last 90 days there is no credit which is received in the account. So in such cases, the account will get marked as NPA. Third condition is that in case in case of an account, if the interest summation in last 90 days, if it is more than credit summation in last 90 days, the account will get marked as NPA. Let me just give you one simple example of this third condition. Let's presume that we are doing audit for say March 2020. So in the last quarter, when we are testing this third condition, there are 3 interests which we need to consider: January, February, and March. So let's presume that January interest was 10, February was 10, and March was 10. So your interest summation in that period is 30 rupees. Now you have to compare that interest summation with credit summation during the same period, that is from 1st January till 31st March. So if your credit summation is more than 30, then the account will be considered as standard. If it is less than 30, the account will fall into NPA category. Now here also the concept is about matching of interest debited with credit summation. This concept doesn't relate to interest servicing concept. So it might happen that you have 35 rupees of credit on say 5th of January, and that is sufficient to take care of your subsequent interest debit. That is more than enough. So you don't have to mark that account as NPA because 3 interests are not serviced. So as I said earlier, in none of the cases you will observe that interest servicing concept is really factored in. So you don't have to bother about that. Now there is one change which has occurred by way of 12th November circular. The change is that the second and third condition, originally these 2 conditions were required to be tested only at a quarter end and not throughout the year. That is, it was not supposed to be tested on daily basis. But from 12th November circular, now RBI is expecting the bank that these 2 conditions should also be tested as a part of end of the day process. So suppose today on say 18th of March, I want to test these two conditions. I have to go backward for 90 days. So maybe say from 19th of December till 18th of March is the block of 90 days which I will consider. So in that December, January, February interest is relevant. So I will compare credit submission from 19th of December till 18th of March. If it is more than December, January and February combined interest, then the account will be PA. Otherwise, I have to mark that account as NPA. Now, because of this, the concept of quarter end has undergone a change, and now we can call it as a kind of a moving 90 days concept. So every day you have to keep on comparing last 90 days. This last 90 days word actually that is also clarified in the circular in this November and February circular. So the last 90 days will include today's day also. So at the end of the day, like 18th March is my 90th day. Like that, I have to go backwards and consider that 90 days block. Because earlier few bankers were interpreting it as last 90 days means from yesterday you need to calculate 90 days. Now that has been also clarified by Reserve Bank of India. Then as far as definition of overdue is concerned, the definition is also given in the master circular itself. If an amount due to the bank under any credit facility, if it is not paid on the due date which is fixed by the bank, then that portion will be called as overdue. Whatever is prepaid naturally cannot be considered as overdue because you already paid it before the due date. So that's why the example which I gave earlier about advance, prepayment of housing loan installment, this will fulfill this criteria because the amount due is already paid. So I don't have to again bother and consider for payment of again interest component. That is not warranted. So these are basic NPA norms. If you have any queries, you can ask the queries, or I can go further. I can go to the next slide. As far as the master circular, October 21 master circular is concerned, there are certain vital paragraphs which RBI has introduced in this circular. So I just thought that I will just pick up those important paragraphs, which are new paragraphs. So first paragraph, the new paragraph is para 4.2.2. This paragraph is a kind of inference which is drawn from September 20 circular, wherein automation of NPA is required to be there. Am I audible till end? Yes, sir. Oh. So I will continue till the time it is installed. So as far as the para 4.2.2 is concerned, it's nothing but reiteration of RBI's guidelines which were issued in September 20, which talks about automation of IRAC norms, that is NPA classification, income recognition, and provisioning norms. Then we have para 4.2.19.3. It talks about credit card dues. The 3 days grace period concept has been specified in that particular para. Then the next para is para 5.6.2.3. It talks about utilization of floating provisions. Typically, this paragraph may not be applicable at the branch level because typically at the branch level, floating provisions are not known. I have just included that for academic interest. Floating provisions is the one which the bank is making over and above BDDR provision and which is declared that this is a floating provision which is made by the bank. So it is not account specific. As the name suggests, it's a floating generalized provision. What RBI has done is, for March 22, that is the current financial year, RBI has given a enabler to the bankers, that is floating provision can also be used for regular BDDR, so that the COVID-19 pandemic impact on asset classification will get reduced to certain extent. Then another para is para 6.2.2, which talks about technical write-offs. Again, technical write-offs are not directly relevant at the branch level, but at the apex level or maybe at the ARMDs, that is Asset Recovery Management Departments, it will be applicable. Now this para has opened a kind of Pandora's box according to me. I will tell you the reason for that also. See the way or the reasons why the banks were using technical write-off methodology was that it is also called as prudential write-off. What it means is there is no waiver as such which is given to the borrower. It's a kind of balance sheet cleaning exercise. So what the bank will do, from both the sides the account will get knocked off. So suppose I am having an account which is having say ledger balance of 100 rupees and I am having a BDDR of 100 rupees provision. So I will knock off both sides. So I will remove that asset account from my balance sheet. I will remove BDDR portion from my balance sheet. So P&L impact is nullified because I am drawing from asset and liability and knocking it off. Second, point is that whenever I am cleaning my balance sheet, I will have an impact on my gross and net NPAs also. So my gross NPAs will get reduced. Third point is that banks will get benefit in income tax calculation also, because whenever you are writing off an account, you get the income tax benefit. Now for these three purposes, bankers were using this methodology.
nowhere the banks have ever waived any, it is not a compromise settlement or OTS scheme. It's only technical write-off. Even the borrower is not even aware that his account is written off. Now, what RBI specified is, RBI is saying that bank can write off an account or technically write off an account only when all measures of recoveries have been exhausted. Now, the problem over here is it's very difficult for the bankers to prove before the auditor as to whether all the recovery measures are really exhausted or not. I will give a simple result.
Let's presume that we are talking about any nationalized bank, and a nationalized bank has maybe say a large portfolio of say personal loan segment. All accounts are say below 2 lakh. It's very difficult to even imagine that the bank can prove before the auditors that all the recovery mechanism was exhausted before writing off all such accounts. It will be going to be a nightmare for the bankers to demonstrate before the auditors as to what kind of exhaustion of measure has been already occurred and why the bank is writing off that account. But anyway, that para is introduced. So as the auditor, we need to ask the bankers to demonstrate before us wherever any write-off is there. As a branch auditor, what I will suggest is wherever you receive, wherever the branch might have written off any account on the instruction of RO or ZO, just make it a point to mention in your LFR that you haven't tested this particular para at your branch level. So that no one will expect from you that this para compliance is required to be tested at the branch level.
Sometimes they transfer it to HO or transfer it to ZO. So they just give advice that these are the accounts which are written off. Maybe in the earlier year, so pass a MOC. So if such advices are there, it's better to disclaim that in LFR that this para is not tested by you. The reason why I'm saying disclaim is to kind of save our skin for the work which you have never performed. Because this is something which is never available at the branch level. This is always at the apex level where the decisions are taken and confirmed by the auditors. Then there is para 7, which talks about NPA management. And in NPA management para, what is really defined is, it talks about requirement of effective mechanism in CBS system, and it also talks about availability of granular data in the CBS system. Now, this para 7, compliance is practically not possible for the banks, at least at current level. Simple example I gave all of you about agricultural loan, that the quantum of granular data which is really required for each and every borrower account related to agriculture advances is practically not possible at this stage. So it might happen that the granular data which is really required to be available through the system may not be even available to you. Then para 21.6 talks about unrealized income which is represented by FITL and provisioning requirements against that. Now, this particular FITL provision, there is additional clarification which is given in November and February clarificatory circular. So let me just correlate that. First, let me explain you what is the concept of FITL, and then we'll come to the point about what is clarified by RBI in November circular. See, what is meant by FITL is a typical case wherein interest has got debited in the account, then that portion is not serviced, or that portion is not, the borrower is not able to pay that portion, so that portion gets carved out. A separate facility is created in the form of FITL. So the interest component is removed from a basic account, that is your main account, and a separate facility is created, and there is an additional period of repayment which is given. Now, in such case, a bank is required to make 100% provision against that FITL component for the simple reason that bank cannot say that income is received by way of sanctioning of a new facility. The income has to be received from the borrower and not within the bank. It's a kind of a journal entry which the bank has passed, credit to a particular account and debit to FITL. So that's the reason FITL has to be provided on 100% basis. And as and when the FITL will get repaid, to that extent, income will automatically get recognized. So that is the concept of FITL. Now let me touch upon the concept which is there in November circular. In November circular, the concept of income recognition or the permission to recognize the income related to similar circumstances is provided, but the cases are different. So let me just give you a practical example. Let's presume that we are having a term loan wherein the sanction limit is 100 rupees. But as a part of terms of sanction itself, what the bank has specified is that for first 6 months, the borrower is not required to make any interest payment. Interest will get funded by the bank. So the bank maybe will disburse 95 rupees, and maybe in the next 6 months period there is an interest component of say 5 rupees which will get capitalized. So in all, we will reach to a limit of 100 rupees, that is 95 disbursed amount plus 5 rupees which is debited and capitalized, and the repayment will be based on 100 rupees. So in such cases, that 5 rupees component of interest will be recognized as income. So here we are already factoring in capitalization of interest. So to that extent, interest recognition is possible. FITL is different and interest capitalization as a part of sanction term is different. So the second part is given as a clarity in November circular. FITL basic concept remains intact. Then we have para 30, which prohibits bankers to contribute to promoters' contribution. Now let me give a practical example wherein the banks are rampantly doing this kind of practice wherein promoters' contribution is very much funded by the banks. So let me give a couple of examples. Let's take an example wherein director is offering his own house property, a immovable property to the bank as a primary security, maybe worth of say 5 crores, and against the 5 crores he has drawn an amount of say 2 crores. The end use is to introduce in the private limited company as a part of his equity share contribution. Now it's an indirect way of funding promoters' contribution. Or take a parallel case that maybe a partner might have availed a loan from the bank and is introducing that as a part of partner's contribution, as a part of partner's capital in a partnership firm. Both these things are prohibited. What is permitted is only limited to the extent of bridge loans which the bank can sanction. So the sanctioning of bridge loan means there has to be a visibility for future cash flows in a very nearby future. Then only the banks are permitted to give bridge loans. Otherwise, such contributions are prohibited. Second exception to the rule is a bank can fund, for the instances wherein a corporate might be interested in taking over some sick unit. So, for example, say in case of say Air India, the bankers can give funding to Tata Group. So it's in a way it's a promoter's contribution, but that is specifically permitted in RBI circular. So in normal circumstances, advances which are given for promoters' contribution are not permitted. Let me just spell out the logic behind that. Broadly speaking, there are two types of end uses are there, or two types of loans are there. One is consumption loan, and second one is normal commercial loan. In case of consumption loan, the end use will not create any income in future. So, for example, if I have availed a loan for say hospitalization, there is no income generation activity which is going to be there. Or if I say purchase say a refrigerator on installment basis, so that loan is a consumption loan. I don't generate any income out of that refrigerator unless I am having a shop wherein I am using that for my commercial activity. As compared to that, typically the loans will be sanctioned in commercial cases wherein income generation capability is created. So loan given for say CC, you are giving funding for working capital which is used for business. So there is an income generation activity. Or maybe a loan given for machinery, or maybe a loan given for factory premises. Everywhere the income generation activity is required. When a bank will fund for promoters' contribution, there is no certainty of income generation activity. That's the basic reason why that is prohibited. So when we have to, when we are weighing any of the RBI regulatory norms or any restriction, we need to go a little beyond that as to what can be the reason why it is prohibited by RBI. So this is one of the possible reasons. Then as far as 12 November circular is concerned, we'll go para by para as to what is newly introduced in that particular circular. So para A is talking about mandating the banks to specify the due dates for each and every repayment. Now what is the logic behind that? The logic is that as a regulator, RBI had come out, have experienced that in a couple of financial institutions, they don't define exact due date. They say that monthly installment is X amount. So exact due date is required because when you are counting or when you are considering whether the account is overdue or not, firstly you need to know that what is the due date. Even if it is a month end, that is fine, but then the bank has to define that every installment has to be paid on the last date of the month or last date of the calendar month. So that 31st, 38th, 28th, all dates will get covered. Second thing is that the repayment schedule or repayment chart is required to be communicated to the borrower. So borrower is also aware as to what is expected from the banker side. Then the para B is specifying about classification of SMA and NPA. That is special mention account and NPA classification. That has to be done as a part of end of the day process. So at every end of the day, SMA and NPA categories will be required to be tested, and accordingly the accounts will be marked based on that. Definition of out of order, it has got changed, which we already discussed. So now it is a moving 90 days concept instead of year-end concept. So two conditions, that is second and third conditions, have undergone a change with effect from this 12th November circular. So 12th November onward, it is a moving 90 days concept till 11th November, quarter-end concept is there. Then as far as para 2.1.3 is concerned, that is a concessionary treatment which was given for term loans, wherein only interest portion is required to be paid. So that paragraph has got removed or made redundant with effect from 31st March 2022. Then as far as upgradation of accounts is concerned, RBI has given a clarity to the bankers
that wherever the entire component or all the areas are paid by the borrower, then only the account will be considered as eligible for upgradation. And that is the date when the account can be upgraded. Now, because of this clarity which is given to the bankers, because this clarity was required for bankers and not really for the auditors, because as an auditor we were well aware of that. But let me just give you a couple of examples, wherein now you can avoid arguments with the bankers about upgradation and other things. Let's take a case wherein because of this moving 90 days concept, an account gets marked as NPA because there is no sufficiency of credits is available in last 90 days. So on the next day, the borrower deposits a lump sum amount, so that deficiency gets removed. So there now in last 90 days there is sufficient credit submission which is available. But the borrower is also having a term loan account wherein one installment is overdue. So in such cases, unless and until even that one installment which is overdue is nullified, that is unless and until it is paid off, the account will not be upgraded. So it's not only deficiency which is because of which the account is getting marked as NPA is required to be removed. All the deficiencies in that particular borrower account is required to be removed. So it's a custody based concept. That is borrower wise classification concept. Now because of that, partial recoveries concept, ideally the banker should not argue with you now onwards, because if you make a partial recovery and some component of overdue or overdraft component is remaining, the account will still remain into NPA category. That is first thing. Second, a good part is that many a times the bankers were having a kind of a perception or under the garb of banking practices that if any account is or if any account or NPA account is getting closed subsequent to balance sheet date, or if any account is recovered or regularized after the balance sheet date, but before signing of audit report, that account can be upgraded as of 31st March. Now, this was a concept which bankers had evolved. RBI never had said that in the circular. There was no paragraph about that. So let's take a case that on 31st March, you are having 4 installments overdue in term loan. So naturally, the account is NPA on 31st March. You are signing of the balance sheet on say 10th of April, and on 5th of April, either the account is closed or maybe the amounts are recovered. In both the cases, the account will still remain into NPA category as of 31st March. The recovery in the account is not an event occurring after the date of balance sheet. It is a normal event which will happen throughout the year. So subsequent recoveries will not really matter for you. It is not your prerogative also. That is your next auditor's prerogative to see that how the accounts are upgraded. Even if the accounts are closed, the same logic should be applicable. Because whatever you are verifying is as on 31st March. And if the banker still argues with you that this is applicable only for regularization and not for closure of accounts, you ask one simple thing, that suppose all these conditions are required to be postponed, like till 5th, 10th or 20th April. Will you mark similar NPA account? Will you similarly mark NPA accounts which are got turn into NPA on say 20th April or 10th of April? Naturally, the answer is no, and that is not required to be done. And once RBI says that it is an automated process, upgradation should automatically happen through system. You cannot have a retrospective effect for NPA upgradation. Everything is supposed to be prospective unless there is some error which has occurred. And now the biggest challenge before the bankers is, and rather it's good for auditor, wherever you come across any divergences in your audit process, which typically we conclude by way of passing MOC. According to me, ideally now you have to qualify the report also because it is a regulatory violation. RBI has mandated the bank that the entire process should be automated. Bankers have confirmed that. So if any NPA is identified by anyone other than the system, it means that the system is not working. If there is an error in master data, it's fine. Then we can understand that once the error is cured, automatically the account will get marked as NPA. But in all other cases, if you find out a single MOC also, it will result into a scenario wherein regulatory violation has occurred. So just keep this point, thing in your mind. Then para F talks about income recognition policy related to moratorium on payment of interest. So these are the instances wherein interest moratorium is given. So the interest becomes due after completion of moratorium period. So income can still be recognized. This is the distinguishing factor between FITL and moratorium period of interest. Then we have 15 February circular. It covers just 3 simple points. First one is that applicability of out of order concept is applicable for all types of CCOD accounts and not restricted only for business accounts. So if you have a personal OD taken, the same logic is expected to be there. I don't know why this clarification was required, but anyway, RBI has given that. But let me just draw inference about this particular out of order status and some issues which are there in couple of banks. I will not name the bank for as a better policy, but I will just draw your attention to a particular product because similar products can be there across many banks. I have seen one of the public sector banks, a large public sector bank, having a housing loan product which was not in the form of term loan but which was in the form of drop line only. So the concept is that suppose as a borrower, if I availed a loan of say 50 lakh rupees, maybe for a period of say 3 years, sorry, not 3 years, 15 years. So every month my limit will get reduced by 1 by 180th portion of my housing loan component. So gradually my limit will get reduced. So there is no monthly EMI which is prescribed. I have to always ensure that my account should be within that revised limit, which will keep on getting revised at every month end. Now that particular bank, what they did actually, they had issued a checkbook facility to the housing loan account holders also because it was a OD facility and it was a drop line OD concept. So under product category, they had categorized this product as CCOD because otherwise you cannot issue checkbook. If you categorize that under term loan, issuance of checkbook is not possible. So the category for product code was of CCOD, but for NPA classification, they had an option in CBS system to choose a product category where they have chosen a product category of term loan. Now, what is the impact of that? Take a similar case wherein the borrower has prepaid all 12 installments. Now here installment I mean to say the reduction of limit. So he prepays that in the month of April and subsequently doesn't do any transaction. Then such accounts are required to be marked as NPA if it is a CCOD facility because in last 90 days there are no credits. Your credit submission will not match with interest submission in last 90 days. So the account should be marked as NPA. Bank was not marking these accounts as NPA because they were using term loan module for NPAs. So that they were just comparing ledger balance with the drop line OD limits. If it is within that, the account was considered as standard account. So pay little more attention to what kind of product a bank is having. If it is a mixed kind of product, you need to go by nature of that product. Now in this particular case, since checkbooks were issued, it's a CCOD facility. You cannot say that it is a term loan facility because further drawings are not possible in case of term loans. Then para B is talking about the previous 90 days concept, the one which you already talked about. So at the end of the day, 98 days today, 89th is yesterday, like that you have to go backward for 90 days. And again they have reiterated, even though it was there in November circular also, in February circular they have again reiterated that the account can be upgraded only when entire arrears pertaining to all credit facilities of that borrower are repaid. So there should not be a single default which has remained unattended whenever the account is subjected to upgradation criteria. Then in master circular, there are certain clarifications which RBI has given related to temporary deficiencies. There are two types of temporary deficiencies which are defined by RBI. One is non-submission of stock statement and second one is non-renewal cases. Now let's talk about the first instance. As far as non-submission of stock statement is concerned, what it means is, suppose a borrower has submitted you say September stock statement, you can use DP of September stock statement for next 3 months period. So for October, November and December, you can use that DP based on September stock statement. After that, you are not supposed to use that stock statement for DP calculation. So in such cases, if the borrower doesn't submit any further stock statement to you, naturally for January, February and March, there is no DP which is available and the account will naturally fall into NPA category because it is continuously owed on. Now this leverage of usage of DP for 3 months, it is available only for large borrower accounts. But what you see in practice is bankers use this leverage for all the accounts. Even if the account is of 1 lakh OD limit also, this kind of remark is used. So you need to be little critical about using this temporary deficiency para. Interesting thing is that what is meant by large borrower is not defined by RBI. So it is left to your interpretation of the skills and bankers' interpretation of skills. If it matches, then there can be a agreement between what is called as large borrower and what is other than large borrower. Second one is about non-renewal cases. So wherever the facility is not regularly renewed within 180 days from the original due date, the facility will be marked as NPA. Now, in many banks, they have a concept of short reviews and technical reviews. So when you are counting 180 days, it will be counted for original due date and not from the end of short reviews and technical reviews. See, short reviews and technical reviews are, these are the facilities which are used by the banks just to continue with the limit. they are not there. They cannot be. It's not a replacement for regular renewals. So if the regular renewal doesn't happen within 180 days from the original due date, you have to mark that account as NPA. Similarly, if ad hoc or TODs are given to a borrower account, and if those are not regularized within 180 days, then that facility will be marked as NPA. Then few exceptions and exemptions which RBI has provided. So if any facility is sanctioned against the security of own bank FDs or NSCs, IVPs, KVPs or life insurance policies, so in those cases, the account will remain into standard asset category till the time the balance outstanding, that is the ledger balance, is not exceeding the security which is available. The moment it crosses the security available, normal IRAC norms will be applicable in those cases. For central government guaranteed accounts, even if the account is otherwise required to be marked as NPA, but if the central government guarantee is live, then in that case you should not mark that account as NPA, but income has to be recognized on realization basis. For state government guaranteed accounts, such exemption is not available. There you have to follow the normal IRAC norms. Similarly, for any advance which is sanctioned against gold or against any other government security, normal norms are applicable. No exemption is as such provided to these categories. Two more clarifications which RBI has given, that your asset classification should be for borrower, that is borrower wise classification has to be there. Barring again two exception to this rule, if a bank has sanctioned loan to PACs and FSS for onward lending arrangement, then in that case, typically in the books of accounts of the bank, it will appear that there is a lump sum portion which is paid to FSS and PACs. And in PACs and FSS books of account, there will be multiple ledger accounts which are opened for the end user, that is the end beneficiary. So it might happen that out of those end beneficiaries or end user of that particular loan, few loans might turn into NPA. So what you need to do as a bank is, you need to carve out that portion out of total exposure to PACs and FSS, and only that carved out portion will be marked as NPA. Otherwise, the facility will remain into standard asset category. Second exception to the rule is LCBD facility. So wherever a LCBD facility is availed by a borrower, the exposure is supposed to be taken on the LC issuing bank. So unless the LC is of your own bank only, then this exemption is not applicable, because bank cannot take exposure on their own. Then it will be considered as exposure taken on borrower. In all other cases, exposure is supposed to be taken on the LC issuing bank. So LCBD facility can remain into standard asset category, but all other facilities might be getting marked as NPA. Then as far as consortium advances are concerned, every bank has to go by their own record of recovery, and they have to consider PA NPA status based on that. So suppose you are having a case wherein say there are 5 consortium members are there. 2 consortium members have marked that account as NPA in their books of account. Rest of the 3 banks can still have that account under PA category because their record of recovery is yet to cross that 90 days barrier. Straight-away classification norms, which we already discussed. There are 2 straight-away classification norms wherein you don't have to wait for 90 days delinquencies. First one is erosion valuation of securities beyond 50% as compared to the earlier valuation, wherein you have to mark that account under directly under doubtful asset category. Second one is wherever the realizable value is of the underlying securities less than 10% of ledger outstanding balance with respect to secured loan, then the account will be marked as under loss asset category. Then in case of fraud accounts, wherein the fraud is confirmed by the bank, if the fraud is not reported within the due date to Reserve Bank of India, then in that case, bank has to make 100% provision against that. In case if it is reported within the due date, then in such cases there is a staggering which is made available. So the 100% provision will be made in next 4 quarters in equal installments. So in the first quarter will be the quarter wherein fraud is crystallized by the bank. So there you have to make 25% provision, and then later on in next 3 quarters you have to make 25% provision each. One of the criteria which RBI has specified, which is little subjective in nature from auditor's perspective, is about the accounts which might be having inherent weakness. Now there are a couple of instances which I will like to put forth before you. First one is that if you are certain or if you are sure that there is an inherent weakness which exists in a particular account, you can straight away mark that account as NPA. You don't have to ask for any representation later also. So if the conduct of account is not good, or if you are aware that say a factory is closed, so in those cases you don't have to wait for that 90 days delinquencies. Let me give you an example. Let's presume that you are aware of a business house
wherein the business house has already closed all its activities. So practically going concern status itself is in danger. So in that case, maybe as on today the account is within the limit, there is no overdue component, but practically there will not be any income which will be generated subsequently. So there is an inherent weakness in that account. You have to straight away mark that account as NPA without waiting for any clarification or without waiting for 90 days delinquencies. In case if you are little doubtful about inherent weakness status, then in that case you need to ask the banker to demonstrate before you as to why in his opinion a particular account is not having an inherent weakness. So that's a representation which he has to demonstrate before you. If you are satisfied, you can say that the account is PA. If you are not satisfied, still you can mark that account as NPA. Let me give a third instance. You will observe that in many accounts which are maybe overdrawn or which are overdue throughout the year at various occasions. In the month of March, everything is paid off. So suddenly they get regularized at the end of the year. So throughout the year, the account might be under NPA category, and in the last week of March, everything is regularized, everything is within the limit. Now, in such cases, you need to go a little step further. You need to analyze as to what is the source of fund which has got credited. Now, the source of fund has to be genuine. What is meant by genuine is it should be out of business activities of the borrower. Now, let me just distinguish between various entries, what we can call it as business activity and what we should not call it as a business activity. So let me give positive examples. What can be called as business activity? So suppose there are long pending overdue book dates are there, and those book dates are realized. It's related to business activity. It's a genuine source of funding or genuine source of credits. Second example is that there might be regular sale proceeds which are received and which are getting deposited in the account. There might be a seasonality in the receipts of the business income which can get credited. So all these are genuine concerns. Let me tell you examples wherein we cannot consider that as a genuine credit. So the example is that let's presume that we are doing an audit of say partnership firm or a corporate, and the directors are introducing loans in that particular company and regularizing the account. So the source is not ingenuine in normal parlance, but as far as the business activity is concerned, it is not getting credited out of business activities of that particular borrower account. So in such cases, even though the account is regularized out of promoters contribution, which they might have made out of their own savings also, still the account will be called as an account having an inherent weakness, and the regularization is not done out of genuine sources of finance or genuine sources of credits, I should say, and the account can still be marked as NPA. Then as far as valuation of security is concerned, the valuation of security is mandatory in cases wherein the account is NPA and the exposure to that particular account is more than 5 crores. So in such cases, two valuations are made mandatory. One is for immovable property which is taken as a security. So in that case, once in 3 years, the valuation is required to be carried out by an external valuator who is on the panel of the bank. Secondly, if he has availed a CCOD facility, wherein stock and book dates are given as a primary security, so in that case, stock audit is required to be carried out by external agency once in a year. If any of the parameters are not fulfilled, you have to presume that there is no underlying security which is available, and you can say that the security value is 0, and based on that, then provision has to be done. But keep one thing in mind: the mandatory part is only for NPAs above 5 crores. So if there is an NPA account which is below 5 crore, there is no mandate that they have to do that once in a 5 years. So it's an optional thing that you cannot practically do anything out of that. So it's a restrictive thing. It depends again on the bank's policy, but adherence to bank policy cannot be said as RBI directive violation. That is an internal policy violation, which can always be surpassed, by simply giving a sanction of not doing a valuation after 3 years. So just keep this thing in mind. Few vital points which we already discussed about NPA norms. First one was automation, which is mandated. Upgradation, we already discussed that entire overdue component should be paid, and partial recoveries are not permitted. Subsequent recoveries are not supposed to be factored in. Now let's come to the point of MSME borrowers. As far as MSME borrowers are concerned, there is a series of circular which has got issued. So I just made a list of that. I'll just quickly touch upon those circulars because for last 3 years all of us have been dealing with these similar guidelines. So there are two vital dates which one has to keep in mind. One is the cutoff date by which the plan is required to be invoked and implemented, and second is the cutoff date where the account has to be under standard asset category. So for the 5th May 2021 circular, there are two cutoff dates. So as an eligibility condition, the account is required to be standard as on 31st March 2021. So if our account is not standard on that date, the benefit under this May 2021 circular is not available. Secondly, the plan, that is the relief measure, are required to be invoked before 30th September. And if it is invoked after that, then these benefits under these plans are not available unless RBI comes out with a new circular for that. Then these relief measures are one-time relief measures. So if any borrower has already availed the MSME relief under any earlier circular, then he is not eligible to avail that under the current circular. The benefit which is available under this particular circular is restricted to those accounts which are having an exposure up to 25 crores. And now that has got extended to 50 crores from 4 June 2021 circular. The account is required to be standard as on 31st March. We already discussed that. Now here that 25 crores and 50 crores cap, they are exposure caps and not ledger outstanding balances. So the distinguishing factor between exposure and balance outstanding is, for example, in case of a CCOD account, you have a sanction limit of say 10 crores. Against 10 crore, your ledger outstanding is 3 crore. So when you are talking about exposure cap, you have to go by 10 crore and not by 3 crores. For term loan, it is balance outstanding which is there because it is not drawable. So that's how that 25 and 50 crores has to be factored in. The account need not be registered under MSME as on the date of invocation, but before the date of implementation of the MSME relief, the account is required to be getting registered under MSME. Then there is a possibility that the account might fall into NPA category between date of invocation and date of implementation. So in that case, once the relief measures are implemented, the account can be rolled back to standard asset category. So that is an additional benefit which is given. Then there is an additional provision of 5% which one has to make with respect to the accounts which are availed the MSME relief. So that's a standard asset provision. It is not a BDDR provision. So that cannot be used for calculation of net NPA. It is part and parcel of standard asset provision only. As far as disclosure is concerned, the disclosure norms which were there for earlier MSME relief scheme remain same. You need to give how many MSME relief, how many borrower accounts the relief measures have been implemented, and against that you need to give the amount of borrower exposure against which MSME relief has been given. Then we'll come to the COVID-19 related circulars, and as I stated earlier, I will quickly touch upon what has changed. These are the circulars which were issued earlier, that is from 27 March to 23rd May. It was a relief which was given in the form of kind of repayment holiday for that 6 months period, which is now already over. 6th August circular was one which is now called as Resolution Plan 1.0. 17th September circular is the one wherein the financial parameters were fixed, which were supposed to be achieved by all the borrower accounts which are availing benefits under Resolution Plan. And 13th October is the FAQs which are published. Current year, as we discussed earlier, these are the circulars which are issued in the current year. Now this 5th May 2021 circular, it talks about Resolution Plan 2.0. So let me just give you highlights of that 2.0 circular in a very crisp manner. All the conditions which are mentioned in 1.0 remain same. Like account has to be standard at the time of availing of these benefits. Everything has remained same. Two major things which we need to keep in mind. First thing is that whichever borrower account which have been granted these relief measures under Resolution Plan 2.0, that borrower account has to be affected by COVID-19 pandemic stress. So if his business is not affected by COVID-19 pandemic, he is not eligible for these benefits. So it is not available for each and every person. So the bank has to prove before you that they have verified that whether the business of the borrower was really affected by COVID-19 pandemic or not. If they are able to prove it, then only this resolution plan will be applicable. This is point number one. Point number two is, in case if a borrower has already availed benefit under resolution plan 1.0, he is not eligible to avail again the same benefit under this 2.0 except one parameter. That except one parameter is the parameter related to moratorium period. So the overall moratorium period which is available is 2 years period. So if someone has availed lesser moratorium period, maybe it's a 6 month moratorium period. So now what he can avail is the remaining moratorium period of 18 months. But otherwise beyond that, he is not supposed to avail any other benefit. So the real benefit is available to the account holders which have never availed any benefit under resolution plan 1.0 and the borrowers where their businesses are affected by COVID-19 pandemic. Rest all conditions remain same. No change is there other than what I have stated just now between 1.0 and 2.0. Only thing is that just have a diligent look about what are the conditions because of which this resolution plan 2.0 is invoked. Banker has to prove before you that that particular business is really affected by COVID-19 pandemic. Because otherwise, what in reality, what is happening is each and every account is getting benefited under that scheme. That is not what is expected through this particular circular. So be little vigilant beyond normal relief measures which are granted. In 5th May, we have two circulars. One is for MSME, and other one is for all other businesses other than MSME and individual loan accounts. On the similar lines, what was there in 6th August circular also. Then in June circular, as we discussed, the limit of MSME has been increased from 25 to 50 crores. July circular has included retailers and wholesale traders also. And the 6th August 2021 circular has extended the timelines to achieve the financial parameters which were given in September 20. So now the extended time is available till this March end, that is by March 22. Just two more conditions which I just want to highlight over here. See the benefit which is available under resolution plan 2.0 and similarly even in 1.0. What was the benefit? The benefit was that all the conditions which were specified in the circular, if they were met at the time of giving the restructuring or refacement to the borrower account, there was a retention of class benefit. If any condition is breached, then the account can be restructured, but it will be downgraded. Now, two vital conditions which you need to keep in mind as an auditor. Because unless those conditions are fulfilled, the account cannot be retaining the class of asset. The conditions are, firstly, whenever the application is made by the borrower, the bank is required to respond back to the borrower within 30 days from the date of application. So if the bank has done any delay in beyond 30 days, then that account is not eligible to get these benefits. Secondly, once the resolution plan is invoked, now what is meant by invocation of plan? The invocation of plan means that is the date when banker and borrower principally agree to go with the resolution. So from that date, the implementation has to happen within 90 days. If the 90 days are not adhered to and the implementation happen on say 91st day also, then the account will get downgraded because you are breaching that condition. Now what is meant by implementation? A normal meaning of implementation is that whatever is the reschedulement, refacement is done by the bank, that should be documented in two forms. One is by way of issuance of revised sanction letter, and secondly by undergoing the documentation which is related to sanction, revised sanction terms. These two conditions are required to be fulfilled, but there is something which is beyond that. What is that something beyond that? Is that the master data is also required to be changed. Because unless and until you change the master data, the resolution plan is not supposed to be effective. And even that is required to be done within 90 days. So if you happen to get a representation from the banker that we have done everything within 90 days, but master data was not changed, and that is a mistake on our part. We will change that right now in front of you. But it means that 90 days norms are not fulfilled as far as the implementation is concerned, and you have to downgrade that asset. Another point is that the cutoff date for invocation was 30th September. So by the time you are reaching branches, everything is supposed to be getting over because 30th September is the last date. After that 90 days, so on 31st December, everything is required to be concluded. So you don't have to really get an answer that it is under process or it will get implemented by the time you finish off your audit. It is supposed to be concluded on 31st December itself. That is the latest date which is available. So this is all about COVID-19 pandemic related circular having a very limited ramification because in most of the banks, most of the borrowers are already availed that under 1.0. So they don't have an option to go for 2.0 except for that moratorium period, wherein 2 years are permitted. So the balance period can be very well be available. And once you avail a moratorium period, the repayment can be postponed to that extent. So suppose you avail additional moratorium period of 1 year, your entire repayment can get postponed to that extent. So that is a benefit available now. Next slides I will just skip. It is only for reference purpose. The 6th August circular I have given in elaborative form. Same is repeated, for that new 5th May 2021 circular. As far as this resolution plan 2.0 is concerned, I have just repeated the same thing, which is now applicable under 2.0. So if you happen to refer to 1.0, refer to earlier slides. If you are referring to 2.0, just refer these 3-4 slides, which is a handy kind of a checklist for you to just verify that whether all conditions are complied or not.
Now, few important circular which you need to keep in mind. First one is 21st August 2020 circular, which is giving a clarity about the ad hoc short reviews, technical reviews of credit facilities. The one which we were discussing about temporary deficiencies, wherein within 180 days the normal renewal has to take place. So many times the bankers used to argue with the regulator and also with the auditors by saying that we have carried out a short review, so count 180 days after that. As an auditor, we were never, never even thinking in that direction.
But RBI has given a clarity for that point from in August 2020 circular. August 21st August 20, there is another circular for new definition of MSME. Just keep that definition handy with you. 14th September circular is the one wherein automation of NPA is mentioned. 3rd September was the Supreme Court order. 7th April was RBI circular. There is a typing error actually. 7th April 2021, wherein RBI issued a guideline wherein when the Supreme Court had concluded that the embargo which they have imposed on NPA marking was removed. So because of the embargo being removed, RBI has clarified that all the accounts should be marked regularly from 1st September 2020 onwards. 7th July circular is the one which is now including the definition of wholesalers and retailers. Now let's come to the point about project loans, that is the project under implementation criteria. Now, as far as project loans are concerned, these are typically the term loans which are sanctioned for setting up of an economic venture. So it can be in any form, maybe setting up of an retail outlet, maybe a setting up of an hospital, hotel, whatever it is. It has to be income generation activity.
And here the definition includes only term loan. It doesn't include CCOD facilities. Now, one more vital point over here is, in case of every project loan, the bank has to define DCCO, that is date of commencement of commercial operation. We have briefly touched upon that in earlier talks. Now, what is the relevance of DCCO is that if in case of project loan, if the borrower is not able to achieve commercial production by that date, the account will turn into NPA. So normal IRAC norms are anyway applicable for project loan. Normal 90 days delinquency norms are applicable, but over and above that, this is the additional norm which is applicable. Now, as far as this DCCO is concerned, the DCCO can be extended subject to certain conditions. So we'll come to that point also. The reason being, in case of project loan, there has to be some kind of flexibility which should be given to the lender to tweak those DCCO dates, or maybe to restructure that project loan accounts to certain extent. So RBI has given that leverage to certain extent. It is a conditional leverage. So in next couple of slides, we'll go through those conditional leverages which are given by RBI. Just keep this thing in mind whenever I am saying that restructuring is possible subject to these conditions. It means that if these conditions are fulfilled, retention of class of asset is available. If the condition is not fulfilled, restructuring is possible, but the asset will get downgraded. So let's start with the first one. It might happen that a project loan is under implementation. So maybe we have given a loan to say for setting up of an hotel with number of rooms of say 100 rooms hotel. And during the implementation phase, the borrower has come back to the bank and now he's saying that he wants to increase the outlay of the project. So instead of 100 rooms, now he wants to build say 130 rooms. So the overall project is outlay is increased. So in such cases, wherever the overall project outlay is increased beyond 25%, then in that case, the bank can again have a relook at that particular loan. They can give additional finance. They can restructure the entire repayment structure. They can again reschedule the DCCO also. That is, they can postpone the DCCO also. So in such cases, the account will not be considered as restructured, and they can retain the class of standard asset. So if the account is standard when this restructuring exercise is carried out, and if all these conditions are fulfilled, they can retain the class of asset. But if suppose the project outlay is not increased beyond 25%, so from 100 it is going to say 120 rooms, then in that case the account will be considered as restructured if any additional benefit is granted, and the account will be subjected to downgrading status. So this is first leverage which RBI has given. Second leverage is about extension of DCCO. Now, within project loan, there are two categories which are defined. One is infrastructure loan. Second one is non-infrastructure loan. So, for infrastructure loan, based on application from the borrower side, bank can extend DCCO to the extent of 2 years without any reasons, without citing any reasons. So, it's a liberal extension which is possible. For non-infrastructure sector, similar facility is given, but it is only for 1 year.
Then if there is a court case, because of which the project is getting delayed, for infrastructure loan, there is additional period of 2 years which is given. So 2 plus 2, 4 years extension will be available. For any other reason, if the project is getting delayed and the reasons are beyond the ambit of promoters, then in that case, additional 1 year is available. So 2 plus 1, 3 years are available. As far as non-infrastructure loans are concerned, irrespective of the reason, wherever there is a reason for postponement of DCCO, you get additional 1 year. So 1 plus 1, 2 years extension is possible. And whenever the DCCO is extended, to that extent, the bank can extend the repayment schedule also. So suppose DCCO is extended by 4 years for infrastructure loan, wherein court case is going on. So in that case, when you extend DCCO by 4 years, you can extend repayment schedule also to the extent of 4 years. But if you extend it beyond 4 years, it amounts to restructuring and the account will get downgraded. If it is up to 4 years, the account will still retain the class. So standard asset will remain into standard asset category. Now, one more benefit, which is available is about the deferment of DCCO, which is now permitted for CRE section also. Earlier, CRE was not included, but from February 2020, CRE is also included as a part of non-infrastructure loans, and 1 year extension of DCCO is even permitted for CRE section. Then, in case of project loans where DCCO gets extended beyond 2 years, in that case, you have to make an additional provision of 5%, as a lump sum provision, as a standard asset provision. Then, as far as sacrifice calculation is concerned, wherever the DCCO gets extended, which is coupled with extension of repayment schedule also, you need to calculate a sacrifice. How to calculate sacrifice is, it is a differential between the discounted cash flow, that is the present value of your original cash flows. You need to compare that with the revised repayment schedule, calculate the present value of that, and the differential between that is sacrifice, which you need to provide over and above the provisioning norms which are there for standard assets. Then one more relaxation is given in case of infrastructure loan where there is a change of ownership. So it might happen that there is an infrastructure loan wherein initial 2 years extension is granted, plus there is a court case, so additional 2 years are granted, and after that there is additional 2 years granting which is possible subject to certain conditions. Now, first thing over there is, if the project is stalled due to the inadequacies or incompetentness of the promoters, and due to that, if there is a change of ownership which is outside the group, that is outside the corporate group, then in that case, additional 2 years extension is possible. So practically it is 2 plus 2 plus 2, that is 6 years of extension, which is possible in such scenario. Again, subject to certain conditions, like the new promoter, that is the new management should take a substantial stake, that is beyond 51% stake has to be acquired. So those normal conditions will prevail. Then there is one more benefit which is available related to retention of class wherever the financing of cost overrun is done by the bank. See, in case of typically most of the project loan, there is a cost overrun which might happen. Now, cost overrun can be funded by the banks by two methods. One is that as a part of normal sanctioning process itself, they will keep one standby credit facility categorically to be used wherever there is a cost overrun. So that is one thing, which is a sanction limit. Second is that spontaneously also bank can sanction additional limit to cover up the additional cost which is incurred due to cost overruns, with only one condition, that cost overruns can be funded only to the extent of 10% of your original project outlay. You cannot go beyond that. If you go beyond that, it amounts to restructuring. You have to downgrade the asset. If you are within the ambit of 10%, retention of class benefit is available. Then coming to the part of income recognition, as far as income recognition is concerned, for NPA accounts, the income will be recognized on the realization basis. For PA accounts, it will be recognized on accrual basis, except with one exception, that in case of central government guaranteed accounts, which are not marked as NPA because of central government guarantee, in those cases, it will be still on the realization basis. As far as FIDL is concerned, we already discussed that for FIDL, you have to make 100% provision. But in some instances, it might happen that instead of FIDL, the borrower might offer some security to the bank as against FIDL. So in such cases, that component will be considered as realizable to the extent of market value of that security, presuming that that security is marketable, in the sense that is a listed security. So let's take an example that suppose a corporate is offering, say, equity shares of their own, and the shares are listed. So when the shares are transferred in the name of the bank, on that date, you have to calculate what is the market value of that particular security, and to that extent, the amount will be considered as realized. As a corollary of that, let me just draw your attention to non-banking asset concept. Now, again, NPA may not be applicable at the branch level, but let me just tell you that from academic interest. See, what is meant by non-banking asset is these are the instances wherein instead of auctioning a primary or collateral security, the bank might acquire the security itself. So these are the typical cases wherein the auctions fail because there is no buyer for a particular security. So what the bank decides is, since the auction is failing for various reasons, let's not get into those various reasons. So if the auction is failing, after the failed bid, the bank will insert the last bid at the threshold level, and the bank will get the asset transfer in their own name. So bank can hold NPA, that is non-banking assets, in their books of accounts, not as a part of advance, but as a part of other assets. Now, when the NBAs are acquired, subsequently, there is a timeline also which is prescribed by RBI, within which the NBA is required to be sold off by the bank. Now, whenever the NBA is received by the bank, in true sense, the realization hasn't really happened. We are only replacing advance with another asset. So in that case, what is important is, even if the non-banking asset is a good immovable property having a good realizable value, still that income recognition should not happen when the NBA is acquired. So let me give an example. Let's presume that ledger balance is 100 rupees, 50 rupees is BDDR. So in my books of account, net book value of that asset is only 50 rupees. Against that, I have made an acquisition of immovable property with a value of 100 rupees. So when I have acquired that property at 100 rupees, naturally I will tell the borrower that there are no dues which are payable to me, because I have acquired your property. So he is absorbed. But I have yet to realize that 100 rupees component. I have only acquired that with the intention that I will sell it in future. So when I acquire it, otherwise, if I realize, or if the borrower has paid me money, I would have made a gain of 50 rupees. Because 50 rupees is my net book value. I am getting 100 rupees. So my BDDR will get unleashed, and that is a gain for me as far as P&L account is concerned. In case of non-banking assets, that's the reason why what one should do is, the non-banking assets will get recognized in books of accounts only at net book values, that is at 50 rupees. Whenever the asset will get sold, maybe at 110 rupees or maybe at 90 rupees, the differential will go to P&L account. So it's a conservative principle which one has to follow, because it is a non-banking asset. As compared to that, if a bank has acquired a property, but they have acquired the property for their own for their own use, maybe a branch might be opened over there. So that is acquired as a business asset. It is not a non-banking asset. So wherever the banking asset is acquired, it will form part of my fixed asset, and not it will not form part of my other assets. So in that case, I can book that income because I have realized that component. It is as good as purchasing the property from any other vendor or any other seller. So in that case, accounting is different. You don't have to go by net book value concept. It's a realized portion which you can account for. Then, as far as the order of recovery is concerned, there is a discretion which is given by RBI to the bankers to decide as to what should be the order of recovery. And once the bankers decide that what is the order of recovery, it has to be consistently followed. Usually, the banks will first recover unrealized expense, followed by unrealized interest, and then whatever balance is left out, that is adjusted against principal. But this is just a general practice I have just noted over here. It's not a hard and fast rule. Every bank can decide their own rules. There is only one exception to this rule, that if there is an agreement between the borrower and the lender, that is the banker, about following a different pattern of order of recovery, then that agreement will prevail. So it will be kind of overriding, beyond the accounting policies of the bank. As far as classification norms are concerned, classification norms are same. That is, you have to categorize into standard asset category, and in NPA we have substandard asset, loss assets, DA1, DA2, DA3. So whenever account will get marked as NPA for first 1 year, it will be under substandard category. Then next year will be under DA1. Next 2 years it will be under DA2, and then later on it will be getting converted into DA3 category. As far as provisioning is concerned, provisioning percentage is same. So as far as standard asset provisions are concerned, the nominal percentage are defined. They haven't really got changed. Even for substandard asset also, the provisioning percentage are same. It is 15% for secured loan, 25% for unsecured loans. And definition of secured loan is also given in the circular. What is meant by secured loan is whenever at the time of sanction of loan, if the underlying value of security is more than 10% of your sanctioned limit, it will be called as secured loan. And till the loan gets concluded, it will be always called as secured loan. So that's how you have to distinguish between unsecured and secured loan. As far as doubtful asset category is concerned, unsecured component has to be provided for on 100% basis, and for secured portion for DA1 it is 25%, DA2 it is 40%, and for DA3, irrespective of the asset value, that is the collateral and primary security value, everything has to be provided on 100% basis. As far as value of intangible security is concerned, there are very few instances wherein intangible security can be really factored in. Easiest example is book debts. Book debts is a classic example that it is an intangible security, but still it is factored because the banker is having the right over the receivable. Wherever the similar right is available with the banker, that value can be considered. Let me give you another example. Let's presume that there is a toll collecting company, and the underlying toll collection mechanism, the right of recovery of that toll collection is given to the bank under a escrow mechanism. So in such cases, you can calculate the present value of future toll collections, and that can be considered as your security valuation, and that can be factored in whenever you are calculating secured portion and unsecured portion. What cannot be considered is copyrights, patents, brand values. Like Kingfisher is a brand value, but that was not supposed to be considered as a part of security valuation. So in such instances, security valuation should be ignored. Similar challenging cases there in case of 3G, 4G, 5G spectrums. These are the spectrums which are practically intangible in nature. These are the licenses, and there are restrictions on transfer of licenses. So usually there is always a debate which occurs, between the bankers and the auditors about whether to treat this as an intangible security and whether to consider that as a security value or not. The litmus test is that wherever you want to consider any value for intangible security which is offered by that particular borrower, ask one question to the bank whether it is transferable and realizable from the banker's perspective. If the answer is no, then you should not be considering any of these. If the answer is yes, it's fine. You can always consider that as a part of your security value. As far as country-wise exposure risk is concerned, it is taken care at the FX level. Wherever a bank is having a country exposure beyond 1%, based on ECGC valuation, there is an additional requirement of making a provision. Then couple of provisioning requirements are there under special circumstances. First one is that wherever a particular borrower account is covered under any insurance scheme, like CGT, MSC or ECGC, then in such cases, NPA norms are same. Only thing is provisioning norms will change. Let me give you an example. Let's presume that we are having a ledger outstanding balance of 100 rupees in a particular NPA account. It's an export house and it is covered under ECGC scheme. ECGC cover is available to the tune of say 80 rupees. So in that case, provision has to be made only for balance amount, that is 100 minus 80, that is 20 rupees. So only the provisioning norms will be changed in case of such coverage. Otherwise, all other NPA norms are one and the same. As far as takeout finance is concerned, the norms haven't got changed. What is meant by takeout finance is it's a typical arrangement between multiple banks, wherein the overall tenure of the loan is divided between different bankers. So suppose the loan is having say 12 years tenure. So maybe first 4 years are with bank B, then 4 years are with bank C, then last 4 years are with bank C. So in that case, whenever an account gets marked as NPA, that debt will continue from one bank to another also. So there is no discontinuation of date of NPA, wherein the account will get first marked as NPA. Then, as far as Exim Bank's guarantee income refinance scheme is concerned, such accounts, that is accounts which are covered under this refinance scheme, will not be marked as NPA because the bank has to just invoke this guarantee from Exim Bank, and Exim Bank is supposed to pay to the bank within 30 days from the date of invocation. So 90 days norms will never get really fulfilled. As far as export project finance is concerned, there is a leverage which is available for exporters. So let me just give a live example. Let's presume that there is an Indian exporter who has exported goods to say Russia, and he is not getting his money back, and the bank has given pre-shipment loan or a post-shipment loan. Rather post-shipment loan is there against that exports which are carried out to Russia. Now there is a restriction which is imposed on Russia, wherein outward remittances are not possible. So in such cases, the borrower can receive those funds within that country, like in our example within Russia. Once the funds are received in the name of borrower, there is an additional period of 1 year is given to that particular exporter to bring back that amount back to India. So in this particular case, suppose suppose he receives those funds within 90 days from that account becoming overdue in his account in Russia, he gets additional 1 year period to get back those funds to India. Couple of things which you need to keep in mind. Firstly, you need to satisfy yourself that the amount is received to the credit of borrower account. In the sense, the borrower account which is maintained in that country. Secondly, that amount is not subsequently used for any other purposes. Because it might happen that he will have funds received in his account in Russia. He will procure certain other material within Russia and utilize those funds. So that 1 year extension is to bring back those funds to India. It doesn't mean that there is additional facility which is supposed to be granted. So these two things which one has to keep in mind, and maybe in the current year it might be applicable to a couple of borrowers because Russia is a country wherein there are regular exports are there. There are various exporters who are regularly exporting to Ukraine, Russia, and allied countries. Then, as far as restructuring of advances norms are concerned, I will just quickly cover those so that we get sufficient time to have question answer also. So, as far as restructuring of advances is concerned, any account can be restructured. Now, the only part which we need to keep in mind is there are a couple of conditions which are given. First condition is that the moment account is restructured, that is required to be downgraded. That is the first condition. Second thing is that restructuring is not possible for an account which is involved in fraud. So fraud accounts cannot be restructured. And third simple thing is that whenever a restructuring is carried out, the restructuring has to be always prospective. Retrospective restructuring is not permitted. So just keep these three conditions in mind. Now, as far as the timing of restructuring is concerned, practically restructuring is possible at any point of time. So whether it is before commencement of commercial operation or whether the account is PA or NP, everything is redundant. You can restructure any account except again fraud accounts, as I mentioned earlier. Now the retention of class benefit we already discussed. It is available in a very limited way. One is about project loan. Second one was COVID-19 relief measure, and third one was agriculture advances, wherein the relief natural calamity has occurred. In all other cases, any tweaking of any of the repayment conditions are seen that you have to consider as a restructuring. Let me just give you a couple of examples of what is meant by restructuring and what should not be considered as restructuring. So first, let me give you an example of what should not be considered as restructuring. Suppose you are having the CCOD facility, and CCOD facility is now converted into a term loan. Now this is not called as restructuring because you are preponing the repayment. Because if the account was continued in CCOD, then that account would have been paying only interest. Principal is never repaid. CCOD continues with the principal portion. Now, if you are converting that into term loan, it means that it's a kind of drop line OD or it's a kind of reducing your exposure. It is not considered as restructuring because there is no benefit which is passed on to the borrower. As compared to that, if a term loan is converted into CCOD, it is considered as restructuring. Because now principal repayment is not there. So there is a relaxation which is given to the borrower. It is called as restructuring. Let me give you another example. Wherever the repayment period is extended, wherever there is a ballooning of repayment which is structured, or wherever there is a standalone benefit of interest reduction is given to a borrower account, all these are the examples of restructuring. Now, what is the exception to that? Suppose a bank is having a borrower and the borrower is getting a better deal with other bank. So right now he is having say 10% interest which is charged by the bank. He is getting an offer to have an interest rate at say 8%, and the other bank is ready to take over the facility. In that case, banker can match that 8%. So whenever because of market competition, the interest rate is reduced, that is not considered as restructuring. But in all other cases, it will be considered as restructuring and downgrading will happen. Now the moment downgrading will happen, your standard account will get down to substandard asset category. If any additional facility is sanctioned, that additional facility will still remain into PA category for next 1 year period. Then as far as upgradation of restructured account is concerned, any account which is downgraded because of restructuring will be, there will be a benefit available that if the account shows satisfactory performance, the upgradation can very well happen. Now, as far as satisfactory performance is concerned, we have to distinguish between two types of borrowers. One type of borrower is an MSME borrower wherein exposure is up to 25 crores. So in that case, the satisfactory performance you have to consider during a particular period. That particular period is from the date when the first payment is made towards the principal portion. From that, you have to calculate a period of 1 year. Within that period, that particular borrower account has to show a satisfactory performance wherein no amount should be overdue beyond 30 days. So it has to be always within the 30 days cap. If that is done, then at the end of 1 year period from the first repayment which is made by him, the account can be upgraded to standard asset category. For all other loans, the resolution plan provisions will be invoked. Resolution plan provisions are little bit tricky. What is tricky is, firstly, the period for which the satisfactory performance is tested is comparatively a larger period. Why I am saying comparatively larger period is, it is the period up to which the borrower has not repaid 10% of overall outstanding.
So it can be 1 year, 2 year, 3 year, whatever it may be, because it will depend upon repayment structure. Now within that period, what is meant by satisfactory performance is there should not be a single default of 1 rupee or 1 day also during that particular period, which is a monitoring period. Now in that monitoring period, even if the borrower defaults for 1 rupee or 1 day also, then that resolution plan will be invoked, in the sense then the account will not be eligible for upgradation. If the account performs well in the span of that monitoring period, the account can be upgraded to standard asset category. So the norms are stringent for all accounts other than MSME borrower accounts or MSME borrower accounts which are crossing the barrier of 25 crores. As far as exposures beyond 100 crores are concerned, there is additional condition that you have to do a credit rating from external agency, and that external agency has to give you a rating of at least BBB minus. Then only the account will be getting upgraded. As far as provisioning norms are concerned, normal provisioning norms are applicable, that is IRAC norms are applicable. For DCCO, as we discussed, there is additional provision of 5% which will be made wherever the DCCO is extended beyond 2 years. Now there is one more provision requirement which is in the form of sacrifice. Now, as far as the sacrifice calculation methodology is concerned, if you look in the July 2015 circular, the calculation methodology was given. In the current year circular, suddenly that method itself has been removed from the circular. But at the end of the circular, the charts of disclosures which are there they have a mention about sacrifice which has to be mentioned. Now, what is meant by sacrifice? We already discussed that sacrifice at the time of DCCO extension, but let me just reiterate that. You have to compare two cash inflows. One is as per the original repayment schedule. You have to compare that with revised repayment schedule cash flows. You have to calculate present value of both the cash flows using the discounting factor of interest applicable to that loan account. So once you get PV using the discounted cash flow methodology, if your PV of original cash inflows is more than PV of revised cash inflows, the differential is sacrifice. That's a hit which you are taking on you. So to that extent, you have to make a provision which is over and above your normal IRAC provisions, and that provision will start diminishing over the residual period of that particular loan, because at every year end you have to again revisit what is the remaining period sacrifice, and the differential will again go back to P&L account. As far as working capital finances are concerned, you have to calculate this DCF methodology presuming that the tenure is 1 year. So only 1 year's discounting will be made. Then RBI specified about special mention accounts as to how to classify special mention account and criteria for that, and it has also defined how to report that. Now, this early recognition and reporting of stress accounts are concerned, it is applicable only for those exposures which are above 5 crores. Exposures below 5 crores, marking is not mandated. For term loan, the criteria is different. For CCOD, the criteria is different. For term loan, wherever the installment is overdue between 1 to 30 days, it is SMA 0. 31 to 60, it is SMA 1. 61 to 90, it is SMA 2 category. As far as CCODs are concerned, SMA 0 concept is not there. So if our account is continuously overdrawn between 31 to 60 days, the account will be SMA 1. If it is continuously overdrawn between 61 to 90 days, the account will be marked as SMA 2. And here you need to keep one thing in mind. As far as three conditions of out of order status is concerned, only first condition is factored in. No credits in the account and credit submission matching concept is not applicable as far as SMA accounts are concerned. It's only overdrawing concept which applies over here. As far as reporting is concerned, credit reporting will happen on a weekly basis. That is every reporting Friday. That is called as reporting Friday. The weekly reporting will be done, and the main report will be filed on a monthly basis. Again, to reiterate, it is applicable only for accounts which are above 5 crores. Below 5 crores, it is not mandated, at least as of now. Applicability of prudential framework, as we discussed earlier. If you want a elaborative guideline, it is there in June 2019 circular. In the current master circular, it is there in para 9, but para 9 is, frankly speaking, it is not really a elaborative commentary. It's it's kind of cramped one. which is there in para 9. So I will suggest that you always keep on referring to June circular. As far as applicability is concerned, when this June 19 circular was issued, it was initially applied to accounts which are having 2000 crores and above exposures. Then from 1st January 2020, it was made applicable for accounts above 1500 crores. And in that circular, it was mentioned that the applicability to accounts which are below 1500 crores will be subsequently announced. So even though almost now 3 years will get over, but that subsequent date is yet to be really factored in by Reserve Bank of India. So practically this resolution plan framework is applicable only for 1500 crores and above accounts. Below that, normal plan will be applicable. That is, normal restructuring definitions are applicable over there. So next few slides, I'm having those slides for reference purpose. I'm sure that most of you are not really dealing with 1500 crores and above, but in case if you come across that, you can make use of these slides. So I will just skip those slides. I'll just touch upon the master direction which I was talking about initially about transfer of loan. These directions were issued on 24th September 2021. It's more from academic interest, but it's an interesting accounting concept which they have defined. The concept of sale of NPA, let me just quickly tell you what is the concept of sale of NPAs to ARC is concerned. So as a part of balance sheet cleaning exercise, what the banks can do, bank can sell off their NPAs to asset reconstruction companies or asset recovery companies, that is ARCs. Against those NPAs which are purchased by ARCs issue an instrument to the bank which is in the form of SR, that is security receipts. Now these SRs, the contribution is from both sides, that is even ARCs contribute, they take a stake in those SRs and the bank also takes a stake. In earlier circular, the stake was supposed to be at minimum of 15%. So ARC were also required to be taking certain stake in those NPAs. And then it was a kind of a joint effort. 85 was belonging to bank and 15 was belonging to the ARC companies. In this September circular, that 15% norm has been done away with. So now there is no minimum criteria. But presumably most of the banks will go by that 15% criteria. So what happens is, when the NPAs are sold off to ARCs, there is a special purpose vehicle which is created. So that SPV company takes over those assets and the recoveries are made through that SPV. And that SPV has instrument in the form of SRs which are issued. So whenever the SRs are issued, out of that 15% is the stake of that ARC company and 85 is by the bank. Now how the bank accounts for that? Again, the net book value concept prevails. So bank accounts for those SRs at net book value of those NPAs which are sold or face value of the SR, whichever is lower. And that's how the accounting will continue. As and when the amount is recovered by that special purpose vehicle company, the amount is given back to the bank, and which is a kind of a redemption of SR. So that's how the accounting of income will be there. So wherever you cross your NBV, the income will start getting recognized. Till that time, principal recoveries will happen. Now, what is the major change which has really occurred is in para 77. So I just want to touch upon that. Para 77 has provided that as far as the SRs are concerned, SRs are also again valued. So let's take a case that 100 rupees is my NPA ledger balance value, 50 rupees is BDDR, so NBV is 50. And for simplification, let's presume that I have got a SR of 50 rupees only. So I'll just continue with that NBV. Now after the SR is created, that ARC company will publish NEV for that. What is NEV? NEV will be calculated based on underlying securities which are available against those NPA accounts. So when the NAVs are published, if my NAV is below net book value, that is my book value, I have to make a provision in my books of account. Similar to mutual fund accounting, wherein it is marked to market. Now in such cases, if the NAV is above my book value, naturally I don't have to make any provision. So this is first provisioning requirement of mark to market of SRs. Second condition is now provided in para 77. What it states is, if a bank is having an exposure in SR, which is more than 10% of my total SR exposure. So in such cases, there is additional provisioning requirement that the accounts which I have sold to that ARC company, which are the underlying assets for that SR, so I have to make a provision equivalent to the BDDR requirement to those NPA accounts. So in most of the cases, the accounts which are sold to ARCs are under DA2, DA3 category, DA2 or DA2, DA1 or DA2 category. So in a year span, typically it falls into DA3. So there will be a requirement to make 100% provision. Wherever there is a substantial exposure is concentrated in a particular SR.
So this is one change which has occurred, not really affecting at the branch level. But if one of you is doing the investment treasury audit, possibly this para 77 will be relevant for you. So I will just summarize a couple of points which we discussed. As far as verification of NP accounts are concerned, first and foremost thing is that verify whether the automation has really occurred in CBS system or not. Secondly, verify the master data which is there in the system, because otherwise your entire calculation of security value in provisioning on NP accounts will go haywire. Accounts which are upgraded in the year, invariably go through each and every account, satisfy yourself that the upgradation is properly done or not. Wherever there is a downgrading which happens due to restructuring, make it a point to identify the accounts which are restructured during the year. And as far as the other points are concerned, one vital point is about recalculation of drawing power. There are a lot of issues which many times occur in DP calculation. The most common thing is that many times the bankers argue with the auditors is that at the time of DP calculation, we will not reduce the trade creditors. I'm sure that most of you must have faced that. And they give a citation of some old RBI circular, which is I think 94 or 96 dated circular, wherein it is stated that if the trade creditors are above CMA level, that is the creditors which are stated in the CMA, there will be say X amount. So if it is crossing that X amount, then only that upper portion should be removed. Now that circular do exist, but practically that circular is required to be implemented in a diligent manner or in a prudential manner, I should say. See, when we are on one hand, when we are saying that whenever the trade creditors are above CMA level, we need to reduce that. We need to understand that there is a presumption behind that your stock and book dates are also above CMA level. If your stock and book dates are below CMA level, you cannot factor in trade creditors as per CMA level. It will be a mismatch actually. And there might be a scenario wherein there is a working capital mismatch, wherein the working capital might be negative also, but still DP might be calculated. So trade creditors has to be reduced whenever you are calculating DP. So DP calculation should be book dates up to certain age, whichever is defined as per the sanction term, plus stock, removing slow moving stock, then reduce trade creditors out of that, then remove margin, and then whatever is left out is DP. Let me just touch upon one more thing. As far as early mortality cases are concerned, always be vigilant about that. Early mortality cases are those which are, these are the accounts which are marked as NPA within 12 months from the date of sanction. So in such cases, there is a possibility of fraud which might has occurred. So be little vigilant about these accounts. Also be vigilant about evergreening of accounts, which is very rampant. Let me give you a simple example of that, which is there across almost all the banks. Typically, this evergreening happens very swiftly in case of gold loans. So the banks do sanction gold loans maybe on a bullet payment basis. So on the due date, they ensure that again another gold loan is given and the differential is given to the borrower wherever the gold prices are increasing. Now this is the typical case of evergreening. Firstly, the earlier loan has to be closed. Then only that security can be used for a new loan. But whenever you observe that a new loan is opened on the same date when the earlier account is closed, there is a high probability that it's a evergreening case. Go a little further, deeper into systems, as my earlier speaker Kuntal was speaking. Go little deeper, find out what is the timing of all the transactions which have occurred. And if you come across multiple cases where on the same date the loan is opened and closed, make it a point to even mention that in LFR that this is a practice which the banker is following, or this is a common practice which are observed throughout the year. How to identify that also I will tell you. Just take a dump of accounts opened during the year and accounts closed during the year and match that using custody as a key field. So you'll get the whole list of accounts which are opened and closed during the year for that particular custody, and you can draw inference from that. Last point is about MOCs and main audit report and LFR. All these three are mutually exclusive from each other, even though they are interdependent. Don't make a comment in LFR, which sometimes is unfortunately observed in certain LFRs, that certain auditors give whole list of all the discrepancies which are available, including 90 days norms which are violated. That is 90-day delinquencies which exist, and at the end they write a suitable decision can be taken by the central auditors. Don't leave any comment without any conclusion. Your every comment should be conclusive. And let me just give you a simple tip about that. See, there will be certain instances wherein you are not able to conclude certain certain things. Like the case which I said, if you observe say 10 loan accounts which are opened and closed, like gold loan, and somehow you are not able to get that circumstantial evidence in those cases. You have done your best, but the branch manager is already aware that the auditor verifies that. So he has taken all the precautions. He has called the borrower in the branch. He has made him stand in front of the cash cabin also. So even CCTV footage is of no use. In that case, what you can do silently is that you can just make this as an observatory comment. Don't conclude in that case. So no one can object on that. You can say that this is a pattern which I have observed in this particular branch, which I want to bring to the attention of the management. So there is a residual clause wherein you can mention everything and anything. So only in these cases don't reach to any conclusion because you are not able to prove certain thing, but we are aware, that something is going wrong. So use that particular paragraph. But otherwise, as far as advances are concerned, conclude that whether it is PA or NPA. Other discrepancies are fine. You are just pointing it out. Another thing is that whenever you are qualifying anything in main audit report, it has to be coupled with LFR elaborative comment. So if you are commenting something like does not disclose true and fair view, or if you are giving a modified opinion in any form, give a elaborative commentary for that in LFR. Vice versa is not expected. Means suppose someone is reading your LFR and he is concluding that this auditor should have qualified the report, that's something which will not really gel. It's vice versa. So whatever is qualification is there in audit report, that has to come in LFR. But LFR should not have a strong comment which is warranting your audit report to be qualified is something which one has to be avoided. As far as MOCs are concerned, I just want to make one suggestion. I will tell you the reason of that. Not yesterday actually, on 15th I was in Ahmedabad, and since it's a close gathering, presuming that it is not getting recorded, I will even name the bank because it's a factual thing. SBI NHO's CGM was present as a chief manager, chief guest, and he made a kind of odd, not comment actually, he claimed certain things. He said that there are 1200 branches under my LHO, and we have a track record that in the last year there was not a single MOC which was passed. It's a half truth actually. The reason is that there are certain banks which will ensure that you don't pass MOC in a different way. What is a different way? Suppose you find out one NPA account, what they will say is that don't pass MOC, we will rerun the NPA program. So they accept your MOCs in a different way. So your MOC looks like it's a blank MOC. In reality, that might be a different thing. Just one suggestion which I want to make is, if such things happen, ensure that you are commenting that in your LFR. You say in LFR, this was the account which was not marked as NPA by the bank. We have brought this to the notice of the bank, and after we brought this to the notice of the bank executives, they have rerun the NPA program, and then the account has got marked as NPA. Secondly, any case which you find out, which otherwise should have been observed by the system itself, make it as a highlighted point in your main audit report by saying that it's a RBI regulatory violation. See, the reason is that the banks are claiming that there is automation which has already happened, and reality is far off, from that claim. I will tell you why I am saying it so strongly. Similar guideline was issued in September 2009. All the banks had confirmed in 2009-10 itself that everything is automated. And after 10 years also the same guideline is getting issued. Again a new deadline is given. Again all the bankers are saying we have complied with that. So be little vigilant. And many times, there is a kind of allegation which is done on typically the bank auditors that there is no value addition because of statutory audit and because of even concurrent audit. Wherever you come across such instances, our report speaks for ourselves as to what kind of value addition we have done. Of course, we cannot measure our value addition based on how many queries we have raised. That is not a parameter. In fact, one can simply ask a simple question to the banker by saying that what is the real criteria when you will accept that there is a value addition? Is it that you are not relying on your own managers, that if a clean report is given, if you say that it is not a value addition, it means that you are doubting yourself. That someone should be positive about that there is no mistake in a particular bank or in a particular branch and there is a clean report which is given. Because by this measurement, almost all listed companies are also having clean reports. If you look at the audit report, it's a clean report. There is no qualification. It doesn't mean that there is no value addition. So, we need to revisit the definition of value addition whenever such kind of criticisms are there. But our report should speak for ourselves. So, always ensure that you are maintaining the quality of report in LFR, in the audit report, in MOCs also. Last point which I want to just harp upon is, in the last year, LFR format has undergone a change.
So 2021 was the first year when LFR format had changed. Apparently, it appears that it's too exhaustive. I have heard many speakers, many CAs saying that it's almost like drawing some inferences from concurrent audit report also. But let me just tell you a background. I will just take 2 minutes for that. The LFR, the revised LFR, which RBI has issued, is on the basis of what ICAI has recommended to RBI. There is not a single change which RBI has made. Only some maybe drafting changes have made. And I will tell you what kind of thought process was there, behind revising this LFR. I'm just saying all these things now off the record because I was also part of that study group. I will tell you the reason why it is so elaborative in nature. Now, if you have seen actually, earlier there were many auditors. I'm not saying that any one of you might have done that, but there were many auditors which were just answering not applicable, yes, no. So it was single word or single line reply. Practically, that is not possible in your revised format. You have to work and you can answer any of the question. Secondly, say as an auditor, we cannot run away from our responsibilities. We need to take certain responsibilities as an auditor as to what we have checked. So that's the reason the list of accounts which are checked is now required to be given in the LFR. So it is saving us also as an auditor that our responsibility is restricted to only those accounts. Suppose I give 10 accounts, I need to say that I have checked these 10 accounts. Why should I keep only in my working paper file? There is no harm in to be vocal by saying that these are the 10 accounts which I have checked. Same concept is applicable further in two cases. You must have noticed that the mandatory accounts which one has to check earlier was 2 crores and the norms were different. Now it is 10 crores. So it is substantially increased, factoring into materiality aspect. Secondly, 10% of exposure is factoring in even the non-fund based exposures. I will tell you the reason behind that. Many times it might happen that you have a funded exposure of 1 crore, but non-funded exposure is 50 crores. There is a risk which is involved with this non-funded exposure also. And such account might get simply skipped from auditor's attention. So that is the thought process behind that. And the last point is that you must have noticed that every branch auditor has to comment upon top 5 standard accounts. It is top 5 standard accounts and not simply top 5 accounts. Because many times top 5 accounts are NPs only. So you don't have to comment anything on that. So that is the, I just thought to share those thoughts with all of you so that you can face new LFR with a positive attitude. Don't think that it is parallel to concurrent audit or something. It's more of accepting the responsibility as an auditor. There is no additional responsibility which is really there in that. In fact, in most of the cases, you will observe that all these things we were already doing. Only thing is that we were not putting that in black and white because the question was not there. So now, whatever work we are doing, we are saying that this is the thing which we have worked. Whenever we are doing the branch audit. So thanks to all of you for patient hearing. And I presume that maybe certain thought process will start in your mind. If any queries are there, we can maybe take a couple of queries, maybe for next 5 to 10 minutes. I have shared this PPT, which will come to every one of you through branch. So you can refer to that PPT. I have shared my contact number also in the PPT itself. So in case of any queries in future also, feel free to contact me at any point of time. And once again, wish you all the best for forthcoming bank audit, presuming that everyone or most of us at least get the bank audit. Thank you very much. If any queries are there, you can ask the queries. Yeah. Yeah.
Conversion. What about the interest portion? No, just to make the interest interest portion is there, then commission is there, then all other items is there.
Right.
That is there is only at the time of resale.
Exactly.
You are telling now.
Correct.
But how it is possible, sir? At the time of transferring all these items to non-banking assets,
yeah,
we have to
remove that.
Is to be removed from that.
Correct.
Otherwise, it will be reflected. What we are already doing, that whatever we are adjusting, that total asset value is to be minus, then the interest portion is to be transferred to the account. Then whatever remaining is there, we have to consider whether it is an asset or asset to be repaid to the parties or to be.
I will tell you, sir. I will tell you, sir.
This portion,
Yeah. Yeah, I will just elaborate. I will give an example so that it will be more elaborative. I will just take a hypothetical example. Let's presume that ledger balance is 100 rupees and IROR, that is contra entry of interest, which is interest receivable, is at 20 rupees. And maybe charges are recoverable to the extent of 5 rupees. Bank has made a provision against that. And BDDR is 50. So overall recovery which is expected from the borrower is 100 rupees of principal, 20 rupees of interest, 5 rupees of bank charges, or whatever charges which are remaining. So overall I need to recover 125 rupees from the borrower. Let's presume that 125 rupees is the value at which I have bought non-banking asset. That is, my bid is 125 rupees. Now my net book value in this case is only 50 rupees. Right? Because for 25, that is 20 rupees of interest and 5 rupees of bank charges, I don't have any value asset because there is a contra provision against that. Against 100 rupees of ledger account, 50 rupees is my BDDR. So net book value for this particular borrower account is only 50 rupees. Now I have acquired this particular account or acquired this particular immovable property at 125 rupees. So my borrower is now absolved. He doesn't have to pay me anything. As far as me as a banker is concerned, I have realized a property, that is, it's a realization in kind. I haven't yet realized that entire 125 rupees portion. I will realize it only when I sell it off. Now, how the accounting happens? Ideally, the net book value, which is 50 rupees, under other current asset, that particular portion will get continued as non-banking asset with a book value of 50 rupees. Whenever, as a bank, I will sell off that asset. Let's presume that I have sold off at 130 rupees, maybe after 2 years. So the difference between 50 and 130, that goes straight away to P&L account as gain or realization on sale of non-banking asset. Correct. Within 7 years it has to be done, and otherwise it has to be again extended. So I have to wait till that time because my asset is not yet realized. Right. 50 and 125. Correct. Yeah. Correct. No, that is not to be kept. Advance account will get closed. So, no, that is knocked off. There is a contra provision against interest. That means we cannot recognize that portion. We cannot recognize. That will get recognized indirectly, not directly, at the time of sale of that NPA, not prior to that. So then the difference is, suppose we are purchasing for our purpose. Correct. Treat as a fixed asset. Correct. Then immediately it will get. Then it is an immediate realization. Just I will add, again for academic interest. If you can, just send me a WhatsApp. I will share with you a couple of annual reports also, which give a elaborative kind of a commentary on how they are accounting for it. Just to draw inference from the accounting practices also. Actually, there will be no regulations or nothing in this type of thing. Actually, RBI doesn't have any guidelines. No, but it's a conservative practice. This type of way. I will just add actually. This is there in bank audit guidance note also. In fact, there is one more thing which is required to be factored in, which I didn't speak out actually, but let me add that. So at every yearly intervals, the bank has to revisit as to whether the value of that NPA, whether it is still realizable or not. It might happen that it will fall below that 50 rupees also, depending upon what kind of asset I will recovered. I will just add one more point. Since you are on non-banking asset, as per IRAC, banks can acquire non-banking asset only in the form of immovable property. Movable properties are not supposed to be acquired. So when the bankers, typically what we see in formal parlance is that suppose someone is not paying vehicle loan, the bank picks up the car. That is not non-banking asset. I just draw inference since we are talking about NPA, so I just went a step further that it is only for immovable property, not for movable. Any other queries or questions? Yeah. You're telling about the takeout loans. Yeah. Suppose bank has the loan, it is taken over by another bank. Right. At the time of takeover, if it is NPA, that is to be continued. Same date is continued. Yeah. So usually what happens is that happened. That not happen because whenever the CBS doesn't capture that. CBS doesn't allow the earlier date actually. It allows only the date of opening of account.
Only the bank, if it is a standard asset.
Yeah.
Otherwise, if you convert it to the standard asset, then only the bank will take.
So that is a precaution which we have.
Suppose
Yeah.
this happens.
Yeah.
How the other banks don't see.
Actually, whenever we are taking any takeout finance, we need to ask the earlier banker as to what is the status of that account whenever the account is taken, and based on that only we have to account.
So in case of housing loan which is categorized with the CCOD,
Yeah.
so the valuation report has to be obtained in every year.
No. It depends upon the bank's policy. Actually, valuation is mandated only for NPAs above 5 crores. Below that, it's up to the bank. Whatever is their internal policy, they will go by that. But usually in housing loans, such policies are not there. For commercial loans, usually they keep various internal guidelines. Like some banks are having once in 3 years even for PAs. They have another guidelines also. Like above a threshold, if the valuation is there, they get a valuation from 2 valuers. Few banks have go a step further also. That if the difference between 2 valuations is beyond 10%, they take third valuation also. But that is internal guide. RBI hasn't mandated it.
And also with regard to the stock audit.
Yeah. Stock audit it is internal matter. They have to decide. But if stock audit is not carried out, there is no impact on PA. It's only LFR point, from statutory audit point.
In case of project loans also, in this DCC, so whether the COVID-19 relief would get to that one.
That is available. COVID-19, the relief is over and above normal benefits which are available. So those benefits are very much available to everyone.
And I have come to certain cases where the sanction, during the sanction period, there will be one interest rate, and in CBS, that rate would be different in that initial period.
Yeah.
So for that period, the income recognition would be understated or overstated sometimes.
Yeah.
So that's an issue, right?
Yeah.
They have to correct.
But practically what happens is for statutory auditor, it's very difficult to find out such cases. You can only draw sample and verify that.
Sample cases
Yeah. If in sample cases, if you find multiple cases, then you have to firstly increase your sample size and then conclude actually whether it is a systemic failure on the part of the bank itself. So that might be the reason. So should we conclude? Thanks to all of you once again, and it was a pleasure to be with everyone. Thank you.
Thank you, sir, for your informative session. I request our secretary to formally deliver the comments.
Very good evening to you all. It's time to mention our deep sense of appreciation to our speaker, Sir Dhananjay Gokhale, for his excellent coverage on IRAC norms. Thank you, sir. Thank you, sir, for the wonderful coverage on the most important aspect on any bank audit. The session was really informative and interesting that even the power fluctuations didn't disturb us. On behalf of Thiruvananthapuram branch of ICAI, we express our sincere thanks and heartfelt gratitude. I request our past chairman, Sri Suresh S, to present a memento to our faculty. I thank all the members who have participated in today's seminar. Without your active participation, this would not have been a success. Thank you one and all. Thank you. We will be having a seminar on trust on 26th of this month. It will be covering the taxation aspect and other procedural aspects too. The session will be handled by Sri C.A. Falgunakumar. Thank you. And there will be Sikasa Bank Audit 2 on 25th of this month. Request all your article assistants to be there on that day.